We intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
We're running strong growth. We're running inflation that's above target, so it makes sense to guide towards higher for longer.
There is a concern on the other side of this that they're going to need a higher neutral rate.
The economy has changed since the shutdown restart, and the Federal Reserve is still struggling to come to grips with that.
The Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We are proceeding carefully, not us. This show's a mess. Chairman Powell, apparently, over at the Federal Reserve. Live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market negative yesterday. The follow-through, not positive. Equities down by 0.5% on the S&P. Yields at the front end, cycle highs off the back of that Fed decision. TK, I think we call that a hawkish pause.
There's a hawkish pause, and cycle high is back to 2006. I'm going to just state it flat out, John. I think it's underplayed this morning. It is a whole new world after all. The real yield burst through 2%. We're out at 2.07% in the 10-year real yield. That affects everyone watching, listening. It affects big business. It affects Wall Street. It affects the fabric of the nation.
I thought he was tired in that news conference. I was getting frustrated listening to him, almost emotional, so I wrote down my thoughts. If I was feeling mean, I'd say Powell sounds totally confused by the Fed's own projections. If I was feeling kind, Lisa, I'd say it was just conveying the appropriate amount of uncertainty that underpins any forecast. Are you feeling mean? Are you feeling kind?
I'm feeling Jim Caron, who said that data dependency means they have no clue, basically. They have no idea what is going to happen. They can't predict it. And so they're basically saying, look, we have a number of parameters, and we're going to go with this baseline. The problem is, to your frustration and the mean side, there is a question of what those parameters and balance of risks are at a time where they seem to emphasize inflation, but still seem to be hoping for that soft landing.
We're very lucky. We start strong. We got lucky here with Andrew Sheets scheduled months ago, and he's going to come in and explain this to us. He had textbooks at Brown University with Bill Poole. None of this is in the textbooks on macro that Andrew Sheets studied with a legend from the Federal Reserve Bank of St. Louis.
I hope Andrew is in a position to explain it, because I can't explain it. In the projections, as Lisa was talking about, they're forecasting a soft landing. Then he says it's not the baseline. It's not the baseline, it's the objective, but we're forecasting it anyway. So what are the forecasts?
It doesn't make sense. And basically he said forecasting is a difficult thing to do, and, you know, it's hard to know, and et cetera. So at a certain point, either saying his forecasts are de facto wrong, or that basically he is not willing to accept the forecasts. I mean, basically he's saying or he's going to redefine it in a new way. It was not coherent.
Let me give you one of the factors here. I was explaining to a young lad in TV today the collapse of Disney. Okay, Disney's got to go out.
Really?
They got to jettison ESPN. What are they going to do with Hulu, John, besides you pay your monthly bill?
I think they're going to take the outstanding shares of it.
They're going to take out Comcast on that.
The whole thing, sure.
Their financing of all that has a new
I'm financing it, for the record.
No, they have a new expense in the last 3 days because this real yield's popping, and it permeates from Disney with Mickey Mouse all across America.
I take your point, and I think it's an excellent one. Basically, it's one thing if rates are high in a short term. If rates are high for a long term, suddenly companies that have avoided paying higher expenses, individuals who have avoided paying higher expenses, have a new reckoning. And suddenly we have to look at a new parameter of potential damage to the financial markets.
End of the year into next year. The regional banks, you look at the Keefe-Bruyette Index, it's a train wreck. And I'm sorry, this redounds directly down to the banking system. Our interview of the day is James Dimon. We're expecting Mr. Dimon to move from Detroit to London to talk to us.
Oh, you think that's going to happen? Like a permanent move or a conversation?
I
think it's a conversation coming a little bit later. Lisa will give you the day ahead in just a moment. Your equity market is negative. We're down by 0.5% on the S&P 500. Yields on a 10-year up another 2 basis points, 4.4313 on a 10-year this morning. In the FX market, more dollar strength. A little bit of euro weakness here, Lisa, 106.53 on euro dollar.
It has been already a central bank bonanza in the past 24 hours. We've already heard from the Swiss National Bank as well as from the Swedish and Norwegian central banks. At 7 a.m. we get the Bank of England rate decision. And what's been happening over the past couple of sessions after yesterday's lower than expected CPI print is people are actually downgrading their expectations for a rate hike. So my focus is going to be on the 2-year UK yield and on the pound, which people say could potentially weaken further from here versus the dollar. Today, U.S. economic data included jobless claims at 8:30 a.m. Existing home sales at 10 a.m. And former St. Louis Fed President Jim Bullard will be joining our own Michael McKee on Bloomberg Television at 8 a.m. And today, the Bloomberg's Global Credit Forum will be happening in London. It's why we're here. We're going to be having a Bloomberg surveillance special at 10 a.m. with Jim Zelter, Apollo Asset Management co-president.
Is he in town to buy a soccer team?
You can ask him that yourself.
I've already asked him. He's not.
Okay, so there
He's
we
not.
go.
I asked him this morning. He's absolutely not in town to buy a soccer team.
That's basically, it's just basically you can have a cheat sheet there. But to me, the big question is, what is the new landscape for credit if you have higher for longer? How does that change the equation for people who have suddenly thought, wait a second, maybe rates are not going to go back down to where we thought they were even a month ago?
That maturity wall out in 24, 25 starts to look a little bit more worrying. Andrew Sheets with us around the table here in London, head of credit research at Morgan Stanley. Andrew, good to see you. Can you square the circle for us? What are those forecasts about at the Federal Reserve?
So I think that this is a case of strategy and tactics from the Fed. I think the strategy is one where even if you ultimately want to pause rate hikes now and cut rates next year, and that is our forecast at Morgan Stanley, we think the Fed is done, sounding more hawkish now, sounding more serious, sounding more vigilant on inflation is the smart move, especially in a world of uncertain data and very high, uncomfortably high inflation over the last 12 months. So I think the Fed would much rather be in a place where it can be positively surprised, where it can talk somewhat more hawkishly now, but ultimately that will allow it to more easily pivot to somewhat easier policy, which we think is appropriate given we think policy is quite restrictive. On the tactics that would allow that, you have some really interesting data coming at the end of this month. You have a big potential GDP revision at the end of this month. We have core PCE, which we think on a 3-month annualized basis in the U.S. is going to fall to 2.3%. So if we get a bit of a downward revision to GDP like we expect and lower core inflation like we expect, it makes the Fed's job a little easier.
Horse before the cart. Do we get a Zentner, Ellen Zentner marking down her GDP view and revisions? Do we get a lower real GDP because the real yield is moving up into a level we haven't seen since December of 2008?
So I think that's part of it. I mean, again, I think the real core question kind of haunting markets at the moment is what is the neutral rate? Is policy really restrictive? And I think that's been a very hard thing for central banks to determine, especially because its rates have risen so much more than anybody expected. But we do think policy is restrictive. I think you're seeing a lot of signs of that, from job growth slowing to core inflation moderating to bank loan growth slowing down rapidly. And so, Tom, I think that's all very consistent with this idea that these real yields are restrictive to economic activity.
So if someone were to say to you, what part of the forecasts are wrong, you would say the unemployment rate, that actually it has to be substantially higher and that there's more economic weakness than the Fed is projecting out. Is that correct? Is that what I'm hearing from you?
So we actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to ultimately relax policy and start cutting rates by March of next year. So it's in core inflation where we differ from the Fed's forecast the most. That's a number we'll know a lot more about potentially at the end of this month.
What do you think is going to be the consequence of a government shutdown, as Jim Bianco said, where you don't get the data? And we don't get the data potentially for a significant part of October, maybe beyond. How does the Fed handle that? How do you as an economist handle that?
That is a great question. And again, a little bit of uncharted territory. So first, we do think that government shutdown will slow economic growth, will be another reason why growth could moderate some into the end of the year. And that's another reason for the Fed to stay on hold. And look, this will put the Fed in a more difficult position. But again, we think it could be still consistent with the idea of staying on hold. We don't have the Fed taking any steps of action until March of 2024 and trying not to do anything radical or significant if we don't think the data supports it or if the data is not available to support it.
There was a great question in the news conference. Shout out Steve Leisman. How many years do we need to be above neutral before we start thinking neutral is just higher? It's a pretty solid question. Did you get a satisfactory response from the chairman?
Well, I don't think we know that as a market, but I think it is fascinating. I think the market is clearly assuming the neutral rate is higher. You look at the 10-year yield at 4.30. That is, I think, very consistent with a higher neutral rate over time. And I do think that is one of the biggest surprises of the last 2 years is we've been in a decade where I think we were sold a story that the neutral rate is incredibly low due to secular stagnation and demographics and a number of factors. I think that's clearly different. So we still think rates are somewhat too high over the long run, but we're clearly operating, I think, in a higher neutral rate regime than we thought before.
I don't think we should allow the Federal Reserve to produce forecasts and then tell us they don't matter. Don't publish them if they don't matter. Do you think they matter? Are they forecasts, real projections, or aspirations? What are they?
Well, I think they are the best estimate of a very smart group of economists, but they are ultimately still uncertain, like any forecast is.
But Andrew, to cut in, their best estimate right now is that unemployment barely needs to rise to get inflation back to 2%. And then the chairman in the news conference totally fails to explain the underlying dynamics and why he's concluded that's the case. He's extrapolating out current conditions this year, out to next year, and the year after that. Don't you think that warrants a bit more attention? Why aren't we getting a sufficient explanation from the chairman and this Federal Reserve as to why they think we found this new way of doing things, that you can get inflation back to 2% without higher unemployment?
So I guess I also feel I need to justify that because that's very similar to Morgan Stanley's own forecast. And I think part of it is that we also saw inflation spike much more than you would expect given the level of unemployment. And so I think we are still seeing some normalization of factors that were unusual over the last several years. You're seeing some healthy elements in things like shelter inflation that could suggest that, again, even with unemployment relatively constant, kind of spot shelter inflation is coming down quite sharply. And some other elements that, again, are somewhat unrelated to the labor market, Medicare being able to negotiate drug prices, lower healthcare costs. That's a big part of spending. That's a big part of GDP. That could also be a source of some disinflationary pressure outside of unemployment.
Let me go to Bill Poole at Brown University long ago and far away, which is a monetarist view of great belief in M2. And I'm not asking you to do an M2 dissertation. But the bottom line is this cacophony of uncertainty is because of massive fiscal stimulus. What's the tail of, as Olivier Blanchard would say, the Biden stimulus?
So this is, I think, I think we could know one number for certain over the next 12 months for economic forecasting, it would be the fiscal numbers, because they're very important and they're very uncertain. These are hard numbers to forecast. If I look at Morgan Stanley's forecast, yes, we have federal spending slowing, but state and municipal spending stays very strong. And so that's a reason why we don't have a larger drag, even though you see these very high deficit numbers that I think in theory would suggest
nominal GDP up?
It does. It does. So that's a big reason why we see a soft landing next year. That's a big reason why we don't think that fiscal reversal is a driver of recession.
So punchline, why aren't you super constructive on risk assets, given everything you've just told us?
So I think it goes to Tom's point about the real yield, that real rates are higher, and that matters, I think, across asset pricing. So we've had a market where the S&P 500 is appreciated this year entirely through valuation expansion. These higher real rates, I think, create some risk there as earnings aren't growing. At the same time, I think many bond yields, many high-grade bond yields where you're getting kind of an average a high-grade spread and then an attractive real rate, those are good. And I think we have seen over time a pause from the Fed has been very good medium term for a buying opportunity in high-grade bonds.
Andrew, thank you, sir. It's good to see you. Andrew Sheets there of Morgan Stanley on the Federal Reserve. One more decision to come today, the Bank of England, on to tomorrow, the BOJ. Plenty of that still to come. Bramo, from your perspective, we didn't get a satisfactory explanation from the chairman. Did you get one just then?
No, except that there's a lot that we don't know, and this time does look different in terms of a soft landing, in terms of the different aspects of the economy that have been moving at different paces, coming together in a sort of jumble of not screaming incredible risk appetite, but at least a steadying of inflation with solid growth. My question with that is, when does a valuation concern become a fundamental concern when some of these businesses have to actually borrow at these rates?
You're thinking high yield.
I'm thinking of high yield, and I'm thinking of cuspy investment grade, the ones that are sort of at the bottom ranks of investment grade. When does that become a serious credit problem that feeds into the economy?
Cuspy.
That was jargony. I apologize.
God's name is cuspy.
It's a new word.
It's like bond talk?
Is that on the cusp of high yield?
Yes, yeah. Okay. Cuspy. I'm actually, so like that was jargon.
Triple B's.
Yeah.
I was over in Mayfair last night.
The ones that are like
John, I was
minus. Yeah. Okay, good.
I was in Mayfair last night looking at Bentleys, and
of course you were.
Yeah.
I look at
we
the
live
finance
such different
here.
lives.
On such
levels. I look at the finance.
I was like shoveling in a shop salad to get to bed, and he's gone to look at Bentleys.
No, you weren't.
You look at the real yield where it is, and those kind of transactions become difficult. That's how you get this.
A lot of those guys
GDP.
are paying cash for what it's worth.
Not this guy.
Live from London.
I'm worth $9 million.
According to the internet, yeah.
Today, Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Chairman Powell down, Governor Bailey still to come, Governor Ueda coming up tomorrow. The Bank of England decision a little bit later this morning. That decision about 40 minutes away. Guy Johnson's going to break that down for you right over there on the corner at Threadneedle Street. We'll catch up with him a little bit later. Let's get to the price action. Equities rolling over on the S&P 500. Negative here by 0.6%. Softer yesterday. Negative follow through. Yield higher on a 10-year to 442.93, up 2 basis points. This move in the 2-year. Let's just sit on that. At the moment, the 2-year yield is a little bit lower at 5.15. Bramo, in the last 24 hours, a whisker away from 5.20 on a 2-year.
It is shocking how far we've come and how we're talking now about 5% benchmark Fed rates for the entirety of next year, barring maybe a couple of months at the very end. To me, this is a sea change. And whether we've seen it actually trickle into the rest of the asset sphere, I don't know the answer yet, and I think that's going to be a big question.
The conversation we were having around the table yesterday is whether we've really started to internalise that high for longer message. Tom, based on where that 2-year is currently, I think the answer to that is yes, increasingly we are.
I'm going to run it every 20 minutes here. It's a whole new world after all, and it is. There's been a sea change in the last 48 hours. You see it in the real yield, and again, it's expressed in the 2-year yield, and the idea that this doesn't have ramifications for U.S. 10-year, or dare I say, John, for Japanese 10-year in 30, unhinged from YCC, that's what the sophisticates. Jordan Rochester's looking at 147, 148 yen at Nomura.
You're right to point to the other side of the currency pair, TK, because if we are in this whole new world, and if we are going to support this stronger dollar for longer, the UK does not want a weaker pound right now. That's for sure. Europe does not like a weaker euro right now. That's for sure. And we're talking about pauses potentially at the ECB and the BOE. At the same time, we're talking about the Federal Reserve with a better growth profile doing the same thing. And yields are going to stay here for how long? How problematic could that dollar be?
There's long, and there's also breaching resistance and support. And in terms of breaching resistance on the 2-year yield, that happened yesterday decisively. And I'm sorry, I can't emphasize enough how I thought most of the media, I thought Greg Epp the last 2 days has killed it at the Journal, but most of the media has missed the seismic change of the last 48 hours.
The TK, the 2-year, 5.15.
Yeah. Right now, we're going to turn to a greater look at international relations. Joining us now after huge negotiations, a professor from UCL, their Center on U.S. Politics, Julie Norman. She's agreed to be with us only because the Baltimore Orioles are this year playing 6:25 baseball. There can be things ascendant and surprising like the Baltimore Orioles resurgence, your beloved Baltimore Orioles. What's going to be the surprise in the next 6 months in the greater sphere of international relations?
Well, I love that intro, Tom. It's been a good year for the O's, for sure. For international relations, I mean, obviously all eyes this week have been on Ukraine, and that continues to be such a central point for so much of everything else we're seeing globally. You know, with the grain deal scuttled, that's affecting the global south. Obviously, Europe is being affected, and of course, the U.S. and their ongoing relations as well. At the same time, as always, we have China as the ongoing challenge, which I think in real terms is really affecting how U.S. foreign policy, how European foreign policy is playing out in so much of the world.
Falkland War, you're too young to remember this. Something happened. There was a French missile called an Exocet, and the rules changed. Are the rules changing in combat and in international relations because of drones?
I wish I could say yes. I think one thing, though, that we've seen from the war in Ukraine is that conventional weapons are still so much at the forefront of that conflict. Drones are obviously a part of it, too. And Ukraine has been obviously increasingly savvy with trying to get some access to those. But they haven't been a complete game changer. We're still relying on the tanks, the armored vehicles, the need for the F-16s and whatnot.
There's a hot war that's been going on in Ukraine. There's also the Cold Wars that have been going on between China and the rest of the world, and increasingly Saudi Arabia with this oil print. And I'm wondering, Morgan Stanley came out and said that Saudi Arabia is going to continue to produce 1 million barrels per day fewer outputs than it had previously until March of 2024. What's the political backdrop for that?
Yeah, so we've seen Saudi Arabia being a key energy player, obviously forever, but definitely during the Ukraine crisis. And we've seen different actors trying to use their leverage with Saudi Arabia, and Saudi, in response, trying to use their leverage as well. And so we've seen them trying to keep this production just low enough that it keeps their profits high, and I think keeps different partners coming to them for different kinds of compromises and incentives.
Some people would argue that this is actually the biggest tea leaf on China's economy, that they have conversations with China, and China orders certain amounts of oil from them. So they have insight that things aren't slowing as much as people previously thought. How much is this increasing an alliance between Saudi Arabia and China versus Saudi Arabia and the West?
Well, it's a great question, Lisa, because the U.S. is following this very closely as well. And as listeners may know, the U.S. right now is increasingly diplomatic with Saudi Arabia, trying to get an Israel-Saudi-U.S. deal, something worked out with the normalization of relations there. That is partly for U.S., partly for Israel, but it's also partly just to counter China's influence in Saudi Arabia and the Gulf more broadly.
The little world here, folks, is we don't really know who's being booked because our team is so competent. They just get out front and do it. And it was brilliant that they brought in Julie Norman here in London. My book of the year is Robert Kaplan, The Loom of Time. You are the first person I thought of when I opened his tour de force. And the heart of his book is the American, led by Obama and Biden, certitude of the Democratic Party and the liberal elite of Washington of democracy and human rights as a template on Saudi Arabia and on the greater Mediterranean. When is the U.S. going to figure out that's not an efficacious policy?
Tom, it's a question that I think each administration that comes in, at least especially Democrats, come in with this ideals of democracy, human rights, and this plan to counter Saudi. We heard that from Biden during his campaigns and whatnot. But the reality is just you can't escape the energy situation, and you can't escape Saudi Arabia because of that. I think the Ukraine war definitely increased the necessity to have that reliance on Saudi in a way that Biden didn't anticipate, but it's one that's not going away.
Is that relationship less important to Saudi Arabia and the Crown Prince?
Well, it's important because I think Saudi is definitely diversifying their partners. For them, whoever is best for business is where they're going to go, and they're not just looking at this from a political lens. It's very economic and financial, and they have a lot of suitors right now.
I just can't point to a single decision that would be a decision that this White House liked. Can you?
Well, that's probably true. I mean, I would say for right now, they're going to keep up their efforts, but it's one that I think is going to take a while, and there's a lot of trade-offs that even within Biden's own party, I think would be hard to completely sell this.
Julie, thank you. Wonderful to catch up with you, particularly here in London. Thank you very much. Julie Norman there of UCL. Bramwell, we caught up with Javier Blas earlier this week, and I think he said something along the lines that Saudi Arabia and their tolerance for economic stress abroad had gone up, that they were far more focused on their domestic finances because of the transitions that Julie's talking about domestically at home in Saudi Arabia.
They want money, and the financials is what take precedence over everything else more than some of these other relationships. And you do wonder what this means in terms of the diplomacy and in terms of how independent different nations try to become. I think about the U.S. and I think about the output there, and then I think about the move to EVs and how uncomfortable that's been, and sort of the intricacies with China. It gets real complicated real quick.
Oh, big time. I'll say it again. We're around 90 on WTI, and we're doing this with crude production in America pushing 13 million barrels a day. It's pretty impressive, Tom, that crude is this high, given we're facing record output in the United States. Is what's happening elsewhere that's causing this.
I mean, the troops will tell me, but I believe tomorrow we have Christian Malik on from J.P. Morgan, and his arch theme is EM demand. This will be must listen if you're in Global Wall Street, like Julie Norman and I are. Christian Malik here on EM demand of oil, John, is definitive.
That conversation coming up tomorrow. Crude pulling back by a little more than 1%. WTI 88.67. Chris Turner, Global Head of Markets Research at ING Bank, is going to join us in about 34 minutes. We will not be talking about, what was that?
The
Baseball?
Orioles.
Baseball,
Okay.
the Orioles.
We will be talking about the Bank of England next.
Nightly.
Stocks down yesterday, stocks down again. We're negative here by 0.6% on the S&P 500. On the Nasdaq, we're down by about 0.8. A whole lot softer here across the board. higher for longer. Stocks down, yields up. Let's turn to the bond market and look at treasuries together. The 2-year through 5.15 earlier this morning,
it's almost
pushing
like a misprint.
5.20 at the moment, pulling back a touch
Somebody
by 3
got
basis
in the control
points.
room got the number wrong.
It's not
That's
wrong.
what it looks like.
514.81, Bramo. That's the big change we saw in the last 24 hours.
Higher for longer. The message is getting very clear, and people are pricing out rate cuts for next year, which is exactly what the Fed said. The read-through to that is really the question. Can you see the rest of the risk asset complex, as you were asking earlier this morning to Andrew Sheets, hang in there if you have rates that are substantially higher at a time where companies have managed to hang on to their previous financing agreements and avoid this completely?
We got to run this through. I get a lot of criticism from people that's literally stop me in bars and say, why don't you keep track of what, Chris Turner and others, what they say, what their track record is? Can we stop right now and say Bill Dudley, Mohammed El-Arian, Andrew Hollenhorst, and a good number of other people absolutely nailed this. If we were 14 months in the past, you'd look at that number on the 2-year piece like you're nuts.
Yeah.
And they nailed it.
I would go, Tom, back to the summer of 2021. Did a conference with both Mohammed and Bill, both at the same time, a conversation. And I just remember walking away from it thinking, wow, these are massive calls.
Yeah.
And what they called for is basically what you see on the screen right now, Lisa. 5.15 on a 2-year.
But wouldn't you think that equities would be in a very different place?
Absolutely.
Wouldn't you think that credit would be in a very different place?
Totally.
And to me, that's the big surprise. That has hung in even with rates where they are.
Even with 5% 2-year, a 10-year in the 440s, a 30-year pushing 450. That's the bond market at the moment. Let's turn to foreign exchange. 29 minutes away from a Bank of England rate decision, we look like this. Sterling a bit softer, negative by 0.4%, 122.96. Under surveillance this morning, the Fed keeping rates unchanged and signalling borrowing costs will likely stay higher for longer. In their quarterly economic projections, Fed officials saying they still expect to raise rates one more time this year, but see fewer cuts next year than they previously anticipated. Bramo, we took back half the cuts that were in the projections from the last set back in June.
This, to me, is really the message that they did manage to get across to the markets, which is higher for longer, having to do with next year. The rest of the forecasts, I think people are shrugging off and saying whatever, because basically the Fed was shrugging them off and saying whatever, we don't really know. And so I think longer term, it's hard for them to give guidance at a time where data dependency, as Jim Caron said, is basically just, we don't know.
Well, let's define people as saying. Chairman Powell said that in his conference, didn't he?
He did.
He basically said whatever.
Yeah.
Whatever. Bank of England rate decision. 30 minutes away. I'm not going to say whatever about that. Traders betting the central bank will pause after 14 consecutive rate hikes, after UK inflation unexpectedly slowed to the lowest level in 18 months. The BOJ is set to announce its latest rate decision tomorrow. We'll have full coverage on that for you, of course, across Bloomberg TV and Bloomberg Radio. For the Bank of England here, TK, this is still pretty split, but I can point to Nomura, who say no hike this morning. I can point to Goldman, who say no hike this morning, off the back of news basically that we got yesterday for UK inflation.
Yeah, you're missing the punchline here. I had the full English today, like 8,000 calories. I even ate, because it's Bank of England Day, Lisa, I had the sausage. So young Ferro here takes me across to the Royal Arcade, and Lisa, I'm standing there. It's almost like where they fed tuppence a bag. And I'm standing there, and I didn't realize, Lisa, everything here is look left, look right. I almost got run over like 3 times just getting to where Ferro wanted me to stand at ground zero.
This is Bank of England discussion.
I just wanted to take in the Bank of England on Bank of England decision day and how nice it was that everything was in London.
I think that's poetic, and his takeaway was he almost got ran over.
I like how concentrated the square mile is in the City of London. There's much more of a community than, say, on Wall Street, where no one is really there anymore.
Correct.
Then the Federal Reserve is down in
I'm
Washington.
looking at Mansion House back to 1282 or something. I'm tearing up.
Finance in London.
Lizzie Burden's laughing at me. Other than that, it was successful.
We'll just carry on talking over each other, Tom. That's basically the show anyway. Stellantis proposing a new contract to the United Auto Workers. The deal offering a similar price increase and failing to give workers the clear vision of the future they are seeking, according to a union negotiator. The union's set to hold a Facebook Live event 10 a.m. tomorrow, where a lot of people are expected to announce whether more plants will join the strike. Tom, it's about whether we get a sufficient offer going into tomorrow morning to step away from deeper, more prolonged strikes from UAW.
My radar on this is up, away from the wage bargain. There are these other issues. And I'll tell you, with this uproar in the United Kingdom over EV and green and Mr. Sunak, it's not that translates over into this strike. but it just shows these other issues matter about new technology, about innovation.
Craig Trudell here in London is going to join us at 8:45 Eastern Time. Good. So we'll have that conversation later, TK.
Joining us right now on this day of the Bank of England, quite seriously, Chris Turner joins us, Global Head of Markets Research at ING. I love, you've got a word in there, you talk about a listless euro, about we're just range bound as well. How can the governor of the Bank of England shift the listlessness today?
Yeah, well, it is split. The market's very split, whether we're going to go with a hike. ING, we think they will hike. We think the soft CPI data was driven by very volatile items, and perhaps that's a factor that the market has overread, and we think Andrew Bailey will deliver that 25 basis point hike and probably retain that kind of hawkish language. So I think that'll probably be a surprise given where the market is right now.
Explain the polarity here between a US 10-year real yield of 2.07% and way below zero, taking out that huge UK CPI, is a negative 2.74 whatever percent real yield in England. Powell and Bailey, excuse me, they have two different worlds, don't they?
Yeah, it's interesting listening to Chair Powell last night about the real yield. He was asked about that and whether, for example, the decline in inflation that was going to happen later in the year would mean that real yields would pick up in the US. But we don't hear too much about the real yield here in the UK.
Why not?
Yeah, I don't know. I think the focus is maybe, getting the message across in terms of trying to manage like inflation expectations, retaining that kind of hawkish bias with rates staying kind of higher for longer. Core inflation in the UK above 6%. I think they've just got to maintain that hawkish message for longer.
John, what do they do? Raise rates 5 times?
They've been busy telling people how much they should ask for in their wage negotiations over at the Bank of England. We're just tourists here. We've got no mud to throw at the great institution across the road from this building. We've had 2 people sit in your chair this week who have said the Bank of England has a credibility problem. Do you think this Bank of England has a credibility problem?
Tough question to ask. I think probably last year, when gilt yields obviously kind of blew out, there was this big sort of risk premium inserted into kind of UK assets. But I don't really see that now. I think they're probably on the fiscal side, for example. I know I'm not talking about Bank of England here, but the fiscal side has been marginally better than expected over the last few months. So we don't see that really showing up in sterling. I think it's fair to say that at the moment. I think what will drive sterling will be, it's all about kind of rates. It's all about will remain hawkish and keep rates higher for longer. And I think that's the big driving factor.
Chancellor Hunt's going to catch up with our team in New York a little bit later on Balance of Power at around 5 p.m. Eastern Time. Joe Matthew, Anne-Marie Hordern. Is Chancellor Hunt going to tolerate a weak housing market in the UK? It's like the most political thing going in finance, in UK economics. Everyone around every table talks about the value of their house when it starts going in the wrong direction as well. Is Chancellor Hunt just going to let that happen?
We haven't heard too much political pressure on the Bank of England at all, really. And I think the focus you hear from the government is that it's all about kind of fiscal rectitude, particularly after the experience of last September. So I think they're very much focused on that, keeping the public accounts in good order.
Well, but to build on that, there's a question about the sterling strength that you see on the heels of a rate hike or sterling weakness on a rate pause or a cut. I don't understand that. If the rate pause is coming on better than expected inflation data, coming in lower than expected, allowing growth to continue, why wouldn't that be positive for the pound?
Yeah, it's currency markets in general. What drives them. Some currencies are driven by growth, some by rate differentials. A lot of quantitative work shows that rate differentials really kind of dominate. And I think if we did get a pause today, you'd see the money market curve perhaps adjust another 10 to 15 basis points lower across the whole curve, and perhaps sterling sell off 0.5 to 1%.
Just zooming out, we've been asking all morning why markets are not responding, risk assets in particular, are not responding more to rates where they are. The fact that a year ago, if we had said this is where rates would be, everybody would have absolutely sold everything that they had. Do you think that this is a market that has already adapted to the rates or hasn't yet seen and realized that this might be the picture for a long period of time?
Yeah, I think we haven't talked about kind of excess liquidity, right? Which is still out there and still being unwound after, during the period of the pandemic. But I think that has been a big surprise that obviously you're talking about Treasury yields up above 5% at the kind of short end of the market hasn't corrected. But, with a prolonged period of rates up here, I mean, unless you see a very aggressive US recession, presumably risk assets can continue to grind out the gains that they have seen this year.
What's the elasticity of the British experiment? I mean, they're going to raise rates, they're going to do this. I look at where the real yield differential is with the US. It's just, it's just stunning, the difference in real yield right now. What can the Bank of England actually do? Can they really affect the system?
Well, you talk about elasticity, and I think one of the important things is mortgage rates, right? And the average rate on the average mortgage portfolio is about 3%. So current mortgage rates...
In the United Kingdom?
Yeah, that's right, yeah. So new mortgage rates like 6%, above 6% for the 2-year, 5.5% for the 5-year. But with like 4% of the mortgage portfolio getting refinanced once a quarter, those rates were going to be rising. So the average rate will move up to 4% early next year, 4.5% by the end of 24. So that's working its way through the economy and has still yet to be seen.
John, and that's exactly what you're talking about.
Yeah, just for comparison, the effective rate in the US mortgage market right now is about 3.6%.
But it doesn't have the
that's going to climb so much more slowly than what we'll see domestically here in the UK, which goes back to the question. We're probably going to experience some housing difficulties in the United Kingdom, maybe much more quickly than we will in the United States. Is that your base case for what you expect here in the UK?
Well, we haven't really seen that since like the early 90s, and I don't think we're calling a very, I think there's very strong demand in the UK. We haven't seen those sort of sharp corrections since like the early 90s. So we're not building that into our baseline, but actually turning to the US, we are a lot weaker than consensus with US growth. You know, James Knightley, you mentioned earlier, Tom, looking at US consumption coming down a lot more than the market kind of prices on the end of the pandemic era savings being used up in student loans, and we're much more dovish on the Fed, and in general we're much more dovish on growth.
Why aren't you baking in more weakness to the housing market with particular focus on the UK, given the fact that there is going to be a reset rate that is substantially higher and is going to make people's baseline costs that much more expensive?
Yeah, I think there is like strong demand out there. I think, you know, for the housing sector, we're not kind of housing specialists here at IG or
No, but it's a larger question, though. It's a larger question. When will these rates start to bite when people actually have to pay them?
So as I said, like those rate increases will be working through like new mortgages into next year. But the big thing is actually a lot more people own their homes. You know, in terms of like mortgages, I think mortgages are only held on about a third of homes.
It's a good point.
So yeah,
very good.
So they're not suffering the higher mortgage kind of
rental prices in London accelerating and accelerating. We started the week talking about that, didn't we? I think rental prices in London up something like 17% year over year.
It was on the cover of the FT
brutal.
today.
Oh, just brutal.
On the cover of the FT.
But if people own, they've moved away from this, particularly because they didn't want to be subject to resets. And so that's why if you do own a home, you're in a good spot. If you don't, oh well, you might be paying pretty high rents.
If you own a home in the City of London, you're probably doing okay. And you're probably happy rates are where they are because you've probably got a load of savings in the bank at the moment.
And you're probably renting it out to who you want to rent it out to.
Exactly.
And then collecting the income.
A different kind of trade, isn't it? Chris, thank you, sir. Chris Turner of ING Bank. Going into this Bank of England decision, ING looking for that rate hike. Others aren't. We've named two of them. Nomura's one, Goldman's another. That Bank of England rate decision about 20 minutes away. Going into it, sterling a little weaker at 123. Alicia nailed it in the FX market. We talked about it with Arcelinios of RBC. What does a hike mean for sterling? Negative? Positive? Which one is it?
What we were just hearing from Chris Turner is that it's positive for sterling. It makes it stronger because ultimately it does follow the rate hikes. At some point, though, you have to imagine if you go back 6 to 10 months, you remember when that wasn't the case, right? When does growth start to drive the FX picture more broadly, especially at a time where rate hikes might be viewed by some as punitive and others, you know, as
and that's the heart of the matter, and I have real trouble with financial media on this. The UK economy is 1/7-ish the size of the US economy, totally different makeup, and to do growth comparisons US-UK is just totally unfair.
It's true. It's true.
Totally unfair.
Dan Hansen of Bloomberg Economics ahead
there?
on the Bank of England rate decision. A third of the way through our central banking triple header. The Bank of England up next.
I'm not cracking the champagne open that inflation's only at 6% in the UK. You know, it's a step in the right direction. Markets trade on the incremental data point. They're going to watch and wait, right? Everybody's data dependent. If the numbers, don't come through, then, maybe there's another hike there. But I think the base case is one more hike and they're done.
Ben Laidler, global market strategist at eToro, looking ahead to the Bank of England decision at the top of the hour. That decision is about 15 minutes away. Ben Laidler, one of a few people sitting around the table with us this week who've actually been constructive. Nice to catch up with some bulls at a time when the equity market is lower. We're down by 0.6% on the S&P 500, down yesterday, down again today off the back of the message from Chairman Powell. And maybe even, I'd throw this in there as well, maybe even just a touch of confusion. That was the takeaway from the Federal Reserve, because a lot of this just accelerated in the news conference. Yields up by a couple of basis points. We are in the 440s on a 10-year. We had a little look at 520 on a 2-year a little earlier this morning, and we're pushing on a 30-year, Bramo. We're pushing 450. We're at 447 currently.
When you say confusion, I think it's a really good point, especially because how do assets trade? How does a market participant trade on essentially faith in some sort of base case when you have a Fed chairman saying, we don't know? I mean, you look at those forecasts, they're sort of a guess. You know, we could change it. We've been wrong before, and you hear everybody saying that. So where is the certainty? The only certainty you get is higher real yields, higher yields. And markets don't do well with uncertainty like that.
We all agree it's right to convey a certain amount of uncertainty around any forecast, especially in the world we're in currently. So I think we all agree with that point. What I struggled with yesterday is when you put out forecasts like the ones they put out yesterday, you have made some assumptions about some underlying dynamics that I think you should discuss openly. Because essentially what you're conveying is that your baseline, because that's what it is, your best guess, is that you can return inflation back to 2% without doing too much damage to the labour market, which is basically the experience of the year so far. You can say simultaneously, we're putting that out there with a great degree of uncertainty, but two, given current dynamics, we think they can continue for X, Y, and Z. That's what was missing from the news conference yesterday.
He should have come out and said the baseline, as you've just seen, is a soft landing. We don't know, but that seems to be what we're looking for. And the fact that he didn't raises some serious questions about the story, the narrative that he is painting around the forecast that he's leaning on.
We have very little multi-decade experience of moving from some form of peak in rates down. We have had a 20, 30-year great moderation. And after the pandemic, we got something new here. And the fact is none of us, including the fancy PhDs at the Eccles building, have any analog to fall back on of where we are right now. And I think their language, they're struggling with the language of it.
You could sense that struggle yesterday, Tom.
Yeah, I can.
I think you put it well.
I think it's at younger institutions such as a Public Bank of England and certainly at the ECB, that's true as well. Someone expert on this, and to give us a brief here, John, help me here. We're 11 minutes away from Bank of England.
11 minutes away. Guy Johnson's going to break that down for you.
Dan Hansen with us now, Bloomberg Senior United Kingdom economist. I was noting earlier the real yield breaking out today, a huge deal in the U.S., a positive 2%. You're doing work in an artificial fiction of a negative 2%, even negative 3% real yield. How artificial is the economy that Governor Bailey has to deal with?
I mean, it's a really difficult one for the bank. I mean, it's very different to the US. Over the past year, the UK has barely grown. So we've had very little growth here in the UK, but we've had extremely stubborn inflation, and that's really been the story. So I think moving into next year, we're actually thinking the economy could move into a recession. And that's a reflection of what the Bank of England is doing. It's lifting rates. It could well lift rates again today. But for us, the economy has been weak. It needs to be weakened further by what the Bank of England is doing to get inflation back to 2%. So I think where we are now, very difficult decision today. We're siding with a hike, but the data has soured, and we saw that inflation print yesterday, and it's made for a difficult decision today.
So headline, recession is the solution.
Yeah, for us, and that's different obviously from what the Fed said yesterday. We've looked at history, and history tells you that you need a sharper adjustment in the labour market. You know, a lot of economists talk about this vacancies divided by unemployment as a measure of tightness. And a lot of economists are saying vacancies can come down, we can get that loosening in the labour market, we can get wages to come down that way. I actually think unemployment does need to rise a little bit. And so that sort of soft landing narrative moves away, and we move towards a harder landing narrative. And just one thing to say about the UK, we have had that rise in unemployment, which is different to the US again.
Well, let's talk about that a little bit more. Let's put some numbers on a little bit higher. Unemployment to where? How much higher does unemployment need to go to get inflation back to target in your mind?
Yeah, so I think for us again, it needs to go above 5. So we're at 4.3 at the moment in the UK. We need to go above 5 for there to be this weight on wage growth. So we think the equilibrium unemployment rate, and this is a debate that's being had in the US as well, maybe a little bit higher now in the UK than it was prior to the pandemic. So actually that means a little bit more needs to be done to push it up, to put that downward pressure on wage growth. So we're looking for a number above 5% to actually push down on wage growth, which still in the UK is extremely high.
That's the wage side of the inflation. For the UK, there's also the import side of inflation at a time where the pound is the weakest, going back to at least March when it comes to the dollar. And the euro has been bouncing around, but still generally weaker. How much of a concern is that for the Bank of England? How much is that going to really play into whether they hike rates today?
Well, I think that's a big reason why they might go ahead and hike rates. Like in the UK, it's a small open economy, so the exchange rate matters a lot. And the import content of the CPI basket is about 30%. So when we have a fall in sterling, it matters for the inflation basket, and it matters for inflation 1-2 years ahead. So that's the policy horizon. So I think that is something that will weigh on their thinking going into today.
That said, about a year ago, there was a question about when rate hikes would be counterproductive for the pound. And now we were just talking with Chris Turner about how a rate hike would cause a stronger pound. Do you agree with that, or is there a point at which that doesn't work anymore if it's followed by the kind of weakness that would get you to a north of 5% unemployment rate?
Well, I think that's exactly the point. At some point, this turns about going away from a rate differentials narrative and towards a growth narrative. And if we're right about the path of the economy, I think sterling's going to take a bit of a tumble on the back of a very weak economic outlook.
You own the high ground with your experience at Treasury on almost the elasticity of fiscal policy, tax policy, over into monetary policy of this United Kingdom. For a foreigner like me, I'm stunned at the stratified structure I see in the UK. Is it just that simple? There's a prosperous London, should I say booming, and the rest of the nation's flat on their back? Is that too simplistic?
I'm not sure it is. I think it's a fair assessment, and it's a lot to do with there are huge regional differentials in the UK, and there's a big strategy here. It's called levelling up. Try and bring the regions up with London, but at the moment the strategy is failing, and London still is the sort of driver.
I mean, John, to me, the vitriol of the press is extraordinary.
Levelling up's not cheap. One way they were going to do this, very simple terms, really fast, big train line going from London right to the north of the country. Pressure now on to cut it back even more, because it's costing too much money.
I mean, it goes to Tom's point about fiscal. So we are very fiscally constrained here in the UK, and it goes to the point about...
this is critical. I don't mean to interrupt. I'm looking out, folks, here at our gorgeous studios at a Gothic tower developed in 1510 by Henry, I believe, the 7th or 8th, I am. What I want to know is that fiscal austerity a cultural austerity or a policy austerity?
That's a policy austerity. I don't think it's a cultural
thing.
They
can fix it.
They think...
Is Sunak trying to untrust Liz Truss? Is that
I think that's exactly right. That's exactly right.
I did okay there.
It's imposed by markets after the experience of last year, I think, is how most people down would
I think
summarise things.
The way it was last year is the markets punish Liz Truss. We're still getting back to a world of trying to get things into a normal place. Yields are higher. That's
the funny bit about all that.
That's hitting the fiscal space.
Yields in some places have been above where they were back then when we had the mess.
Quite. And that means... Sorry, Tom, you go.
No, I don't mean to interrupt, but this is important. Lisa, should we move the show here permanently?
Because of...
We got guys like Dan Hansen, and we can get up later than the 3 a.m. act
I think that's the important piece of this, right? The fact that it's midday.
You're going to be in training to cross the street, and then we'll see.
I just think
you can look the right ways.
You want to make happen. We talked about this a long time ago, about maybe moving the morning show to the afternoon in London.
I could get Tots tickets and,
I'll carry on saying good morning. We'll be season ticket holders, TK.
Yeah, see,
Can make that happen.
I could, Adele can come talk to me about Tottenham.
We can have Adele sit around the table, sure. Yeah. Dan, it's good to see you. Thanks for this. Dan Hansen, Bloomberg Economics, looking for that rate hike.
Dan says we should move
in about 5 minutes' time. That Bank of England rate decision just around the corner. I said it was a central bank in triple header, and we're a third of the way through. We've had the Federal Reserve, the Bank of England still to come. That decision in about 5 minutes' time. Guy Johnson's going to break that one down. And then tomorrow, it's the BOJ. Here's the setup for you. Stocks pulling back yesterday, pulling back again this morning. Equity futures down by 0.6% on the S&P. Some headlines in the bond market. 440s in the 10-year, 442.53, yields up a couple of basis points on a 2-year, pushing 520 a little bit early this morning, currently pulling back to about 5.15. Your Bank of England rate decision is coming up next. Live from London. Good morning.
We intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
We're running strong growth. We're running inflation that's above target, so it makes sense to guide towards higher for longer.
There is a concern on the other side of this that they're going to need a higher neutral rate.
The economy has changed since the shutdown restart, and the Federal Reserve is still struggling to come to grips with that.
The Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Well, there's a split decision. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro, and I'm not talking about the Federal Reserve. Rates unchanged at the Bank of England, Tom. The vote split, 9 members of the MPC, 5-4 in favour of maintaining interest rates exactly where they are at 5.25.
This is a surprise. It'll be interesting to see the defense makeup. You see a 5-4 in terms of maintaining. That's the kind of tension, John, maybe obscured in Washington. It's very visible feet away from our offices.
That's the decision. Here's the signal they want to send this morning, Lisa. Further tightening required if inflation persists. It feels like this week's CPI print, bit of a game changer for this BOE.
I want to hear, though, from the specific members. And what I think that Tom just said there is actually really important, that maybe some of the confusion that we heard from Fed Chair Jay Powell trying to put a narrative around projections is really displayed more in the fore here when you have a 5-4 decision. It's like a Supreme Court decision in the U.S. where you have people lined up on both sides with evenly split types of situations. It raises a question of whether this will be helpful for the Bank of England to go out and say, we just don't know, or whether it will be harmful in terms of credibility and guidance.
You wanted to know what it meant for pound sterling, so let's talk about that. The pound against the US dollar, 122.65, just rolling over, just a touch more. We're negative on that currency pair by 0.6%. Any similarities between this decision, Bramo, and what we heard from Chairman Powell yesterday? My conclusion, whenever we ask that question, is no.
It's a completely different economy. I think that that's important. I think that the fact that all of the central banks that we've been tracking seem to be reaching the peaks of where they're going to at least pause and calibrate whether they need to raise more rates highlights what they talked about is that, you know, the risks on both sides are becoming more evenly calibrated. And that seems to be very much here, even though Governor Bailey says there is no room for complacency.
John, you're better at this than I am. Conliffe, the deputy governor, Megan Green, Catherine Mann, and Jonathan Haskell, they voted to raise rates. And I think a key question here for particularly Catherine Mann and Megan Green, who we know so well at surveillance, is what was the single justification to raise rates that the rest, the majority, pushed against?
Clearly, they didn't pay much attention to that inflation report yesterday and wait the decision just on that, because Nomura and
Goldman, a real rate analysis,
they dropped their calls on a rate hike this time around based on that print this week.
And I can voice the wonderful Dr. Mann, who I've known for decades, on a real rate analysis, they have to raise rates.
I asked about similarities between the Federal Reserve and the Bank of England. This language might sound somewhat familiar, that policy must be restrictive enough for sufficiently long at the Bank of England. Guy Johnson standing by outside the British Central Bank. Guy Johnson joins us right now. Guy, your take on this one, please.
I think they're using the vote split as a signalling mechanism. They're signalling that it is very difficult at this point to make an accurate decision on where the economy is going, or get an accurate kind of feel of where the economy is going from here. Basically, what we're looking at here, John, is a balance between the inflation data we've seen this week and the wage data we saw last week. The wage data was strong, the inflation data wasn't. But within the inflation data, some of the things that dragged it lower are quite volatile. So we can't really at this point make an accurate call as to what happens next. So clearly, the Bank of England has made a decision that for now it can wait. It can wait and see what happens with the economy, see what happens over the next few months. They've raised rates by 14 times already. Are they going to continue to raise them further from here? Or are those 14 rate hikes going to be sufficient to slow this economy down, to raise unemployment, to take some of that steam out of the wage debate that they want to see at the moment? The other thing I should flag as well, John, is that they have raised the QT target to a higher level than was anticipated. So there is some hawkishness there, and I wonder whether or not that is what the hawks will take away from this. They've gone to 100, they were at 80, there was some talk that they would go to 90, but they've gone to 100. So maybe that's where the balance comes in here.
Guy, I mentioned the CPI print that came out earlier this week. We also need to talk about the growth profile in the United Kingdom. A curious headline across the Bloomberg from the BOE. This from our colleague Luke Morano, pointing out that policymakers saw UK PMI surveys due out on Friday. Guy, from your perspective, what would you expect to see Friday based on that headline?
Maybe some weakness. We'll hear from Chris Williamson and his data tomorrow at market. We'll see what that data tells us. But that data has been weakening quite significantly. We've already seen, obviously, weakness within the manufacturing sector. That's been there for a while. But the last set of data told us that we're starting to see some weakness into services as well. And that could have been, John, the tipping factor that maybe led to this vote split that we've got here. Maybe we're not just balancing out that wage data, that CPI data. If you fold in the PMI data, which, as you say, maybe they've seen, that could have been actually what tipped it the way of a hold rather than a hike. Tom?
Guy Johnson, you're knee-deep in this on a daily basis. How much are experts tilted towards a recession call in the United Kingdom?
I think there probably seems to be a growing majority of people that do feel a recession is coming or may already even be here, Tom. That's the thing as well, that the recessions are usually only observed with hindsight. And it looks as if the data are deteriorating here. The UK economy obviously is very hard to call at the moment because the ONS keeps revising the data. So very difficult to get an accurate kind of assessment of what is happening. But there does seem to be some evidence that this is an economy that is slowing down, maybe is slowing down relatively rapidly. There is still a lot of policy tightening in train, i.e. that's still to hit the economy. And as a result of which, maybe that is the conclusion of the Bank of England, that they are now seeing some of the effects that they want to see, that slowdown is coming. But maybe they just need to see more of it in the wage data to conclude that they're not at the top of Table Mountain, they're at the top of the Matterhorn.
Interesting. Guy, thank you. Appreciate that analogy as well. Guy Johnson, thank you, sir. Out of Bloomberg at the City of London on the Bank of England's latest rate decision, unchanged, 5.25, but a big split on that committee, 5.4. And Lisa, I think we've got to pick up on the growth profile, not just the inflation story. Growth in the United Kingdom, the outlook coming from this Bank of England, not exactly sending this really positive signal about the outlook, are they?
It's completely different than the U.S. When you talk about the similarities, this is a pretty big distinction. They revised downward their third quarter GDP growth to 0.1%. It had been 0.4%. So they are looking at weaker growth, not stronger growth, and they are adjusting accordingly at a time possibly to justify why they kept rates on hold for the first time in nearly 2 years.
All will adapt, and very importantly, asset managers will adapt. With Aberdeen, Sri Kochagovidian joins us this morning, their senior research economist. The growth issue there is just absolutely tangible and germane to a shop like Aberdeen as well. Are you calling for a recession when you see the split of that, the tension of a 5-4 decision?
I think that's right. We are looking for a recession later this year, actually, and one that continues well into next year, possibly the first 2 quarters as well. Now, if we look at the data that we've seen recently, obviously there can be some revisions in the GDP data. We saw quite a contraction in July. Now, we are expecting, perhaps there are some quirks in the data that we haven't seen as much industrial action recently, and there could be some technical issues and a rebound. But I think the outlook for the rest of this year is quite weak. And we see that, as you've mentioned, in the PMI surveys, both manufacturing and services moving into contraction.
Well, let's talk about the market response. You are seeing a weaker pound in response to this, as many people expected it would. At what point are they between a rock and a hard place at the Bank of England? If they don't hike, the pound weakens, it increases inflation, even as growth slows. How much is this going to be a real consideration for them going forward?
I think obviously imported prices are going to be a consideration, but what we saw earlier yesterday in terms of the inflation data was very promising. And I think one of the key metrics that they focus on, what really changed, was that core services data. We saw a deceleration there as well. But I think it's still very elevated. We are still seeing another key metric of wages are still very high, and hence this signalling through the split and the announcement of QT. Something that we've been expecting for a while is that they will increase the pace, the run rate, but they've done that today, and I think that's an interesting communication issue.
Well, what is the signal? right from the split, other than they're just divided? It is a difficult moment. What is the signal that you can take away as an economist coming up with your own projections?
I think really what we're seeing is they are worried about the recession. They are worried about weaker growth, and they think that perhaps going into the rest of this year, inflation is likely to continue to decelerate. So what we're seeing is the lagged impact of fairly aggressive monetary tightening really starting to bite. And they're probably thinking, right, that here is a time to pause, but we don't want to get too complacent. There are still a lot of inflationary pressures ahead, and there's a long way to go before we go anywhere near target.
Sri, help us understand the bond market move in the gilt market right now. 10-year gilt yields are higher on the session, near session highs, up about 7 basis points. Does that stack up for you?
I think it's a knee-jerk reaction, perhaps. You know, the hawkish signal there is really being the focus, I think. But what we will say is, even though we are very close to the peak, we do expect rates to remain elevated, and we're thinking more Matterhorn rather, more Table Mountain than Matterhorn, really. So really on hold, elevated for a long period of time, well into next year.
Could I offer an explanation? Do you think to some extent this might be a Bank of England that's starting to become more concerned about growth over inflation, and a bond market starting to pick up on the scent of that?
I think there is a shift. I mean, it was a very, very close call, and I think that inflation number really sort of tipped this decision. There are some other disinflationary pressures with, food prices are likely to continue to drag down inflation to year end. But as you say, we're still nowhere near target, and I think that the growth priority is starting to pick up.
Back to your work at Queen Mary in London, do you find it more beneficial to have a highly visible, dissenting, nuanced split vote like at the Bank of England, or are you more able to make theory and forward-looking views over the "we are the world, we're all in it together" view of the Fed?
I think the split is part of the signaling. I think that's actually quite a useful signal, and you can see that in the bond markets. They're taking this as a hawkish pause, and that's actually what is necessary in a sense in order to continue on this path of disinflation. Unfortunately, we need a recession to really correct some of those imbalances that are quite particular to the UK economy.
No change isn't boring, TK, in London. No change is not boring. 5-4 split.
I'm fascinated by it, and to know the heritage of Catherine Mann at MIT and Megan Green at Oxford, and these are huge decisions, folks. This is not a small matter, and I go back to the real yield. I know Kit Jukes is all over that in his morning note as well.
Sri, thank you. Sri Kochagovindan of Aberdeen. If you are just tuning in, welcome to the programme. Equity futures, session lows, negative 0.7%. A lot going on in this bond market. Yields up 2 or 3 basis points on a 10-year, 443.54. A little bit later on today, Jim Bullard, the former St. Louis Fed president, sits down with Bloomberg's Mike McKee.
Well timed.
We were wondering, Bramo, you and I talked about this a few times, would we hear less from Jim once he'd left the Federal Reserve? And we happen to be hearing more from Jim Bullard since he left the FOMC.
It doesn't completely surprise me. He's never been one that's shy to share his opinions, and I'd be curious what he has to say about what we were just talking about with Sri, which is growth trumps inflation, essentially, for this Bank of England. Is it starting to do the same for at the Federal Reserve? And was that sort of the subtle messaging behind, well, we don't want to say Goldilocks is our base case, but it's not our base case, because check out our forecasts.
First of all, it's un-American. He's got an Indiana University PhD, and he's got a shingle out at Purdue. He's boiling up, and I don't get it. But the answer is Jim Bullard's going to tell you we will not roll over and die with high interest rates. That's going to be his core belief.
I wouldn't go as far as saying that growth is more important than inflation at the Federal Reserve. I would say this, though. This Federal Reserve, based on these projections, if you want to ascribe a meaning to the median, to pick up on some of the language that Chairman Powell used, they're basically forecasting that growth doesn't have to get hit that hard to get inflation back to target.
And they are forecasting they're not going to have that very difficult medicine of higher unemployment to face off with as they potentially raise rates further.
No change at the Bank of England. Plenty of changes elsewhere at the UN General Assembly. Bloomberg's Anne-Marie will join us next from New York. Live from London for our audience worldwide. This is Bloomberg Surveillance.
Today, Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
No change at the Federal Reserve, a hawkish pause. That's what a lot of people on the south side are calling it. That was Chairman Powell at the news conference just yesterday. A triple header of central bank decisions this week, three major ones anyway. The Federal Reserve behind us, the Bank of England just behind us, the BOJ still in front of us. On the Bank of England, unchanged, but a 5-4 split. So 5 voters of that 9-person MPC voted to keep rates unchanged. Lots to discuss. The price action at the moment looks like this. Equities near session lows, down by 0.75% on the S&P 500. The Nasdaq futures really struggling, down about 1 full percentage point. Off the back of this move in the bond market, yields up by a couple of basis points on a 10-year to 4.43 on a 2-year. Very close this morning to breaking 520. Pulling back since then. We're down about 2 basis points at the front end, Tom. 5.15 on a 2-year yield.
Kitchuk's scheduled to be with us later. We'll do some really careful real yield analysis on that, Jim. But John, I'm going to do some Nasdaq 100 analysis, the roulette wheel of the American stock market, and it moved off the Bank of England. The fact is, we were down, but there's a leg down off the BOE news. This has got a global feel to it. I really wonder what the knock-on effects is to a unique and fragile Japan is as well. That BOE decision, what does it mean tomorrow for the Bank of Japan?
If you want some more direct knock-on effects, I would go straight to pound sterling. We gapped lower just a little bit on the pound against the US dollar. We've bounced back since. The pound cable, so to speak, 122.71. We're still negative on the session, though, by 0.6%. The outlook for the UK is messy. Bramo, it's not like the United States. The Federal Reserve is saying, yes, we can get inflation down, but no, we don't have to see too much pain in the labour market or, for that matter, the broader economy. For the UK, there's a concern about what we might see now in the PMIs that come out on Friday, tomorrow.
And you were talking with Sri about the idea of growth trumping inflation. Do we continue to see that right now in the UK, which is maybe why there is this knock-on effect? At this point, around the world, maybe for different reasons, but around the world, isn't there a sense that we're going to have higher for longer, and that's where really the pain's going to come in, is maybe next year when rates are at this level?
High for longer, there are similarities, different consequences. We can all agree on that, based on the projections we're getting so far, Tom, from the Federal Reserve and what you're hearing from the Bank of England this morning.
We'll address this more in the coming days. Is a recession in the UK like a recession in Germany? I don't think so. I think they're two different beasts.
In what way, Tom? Manufacturing versus services?
Germany's a massive manufacturing, exporter, relationship with China, and I think England's its own unique beast.
When it comes to inflation, though, big exposure to the FX channel. Dan Hansen of Bloomberg was talking about that.
Well, yeah. What do they do with their models here? Do they break it down to 120?
Doesn't
go
help.
119?
I don't think 106, 107 helps the ECB, for that matter, either.
Yeah, it's going to be interesting to see. We're going to turn our attention right now to Washington. 3 or 4 ways to go with Anne-Marie Horton, Bloomberg shutdown correspondent, with us this morning. How close are we to shutdown? I know it's X number of days out. Are we going to fly back, Anne-Marie, to a Washington shutdown?
Well, we're 9 days away, so they do have a little bit of time. So I imagine you'll be back, and the government will still be open, of course. I believe you're coming back next week, Tom. You missed our bilateral meeting we were supposed to have here in Manhattan. But when they come back, I cannot say whether or not they will have an agreement. They probably will not. What we are seeing, Speaker McCarthy held a meeting last night. It was about 2 hours, and it does look like he has been able to flip some members of the rebellious, if you will, right flank of his party who are refusing to sign up to the continuing resolution that he wanted to put on the floor, but still unsure if he has the votes yet. What he is doing is the debt ceiling strategy, which is make sure he can keep his party together, the Republicans together, to pass a bill, even though this is going nowhere with the Senate, which is controlled by the Democrats. But at least he's able to show his right flank of the party that he's explored all of these options.
Right.
And even in that, there's a $64 billion cut to what was already agreed upon with the White House with the debt ceiling negotiation. But then it does potentially give him some cover to that when a more cleaner continuing resolution comes to the floor, he's going to have to work with Democrats to get that through.
So Civics 101, if the rebellious, as you call them, I love that, if the rebellious shut down the government, can the Senate block that shutdown action?
Well, the Senate can also work on their own bill, and then that will have to go over to the House. There's going to have to be a conference. There's going to have to be a dialogue at some point once everyone goes through these exploratory measures of their own kind of bills that they would like to see in their respective bodies. They're going to have to come to some sort of agreement that gets past the finish line. The question is whether or not they can do that before October 1st, or if they're going to need some more time and we would see a shutdown.
And I'm sure we'll be talking about this with you over the next 10 days ad nauseum as we get closer to what many assume will be a almost sure thing of a shutdown. Anne Marie, one of the things that's on the table is funding for things like the Ukraine war, which has gotten actually increasingly controversial, not just in the U.S., also recently in Poland with questions around arms deliveries. We do know that there have been discussions between Volodymyr Zelensky and President Biden. What's the latest in terms of the pressure on stopping some of the funding on the U.S. support for Ukraine in this war?
It really depends who you ask. And we should note that the funding for Ukraine is not even in this continuing resolution. So they're going to have to deal with that separately. But while Zelensky is here in New York, and I actually saw him speak last night and spoke to some of his aides as well, the big meeting for him is not going to be the Oval Office meeting, which he is going to ask for those Army tactical missiles. They're called ATACMs. They have been asking for them. There's been reporting that potentially the White House is going to go ahead with those, and maybe we'll see some movement on that today. But the bigger meeting is when he goes to Congress. And I spoke to one of his aides last night, and they said that Mitch McConnell, the Senate Minority Leader on the Republican side, and Speaker McCarthy will be in that meeting. And this for them is really paramount, because the White House has asked for more than $20 billion for more aid for Ukraine in that supplemental spending package. And there has been concerns from the Republican Party and also in some of the polls you see of just the American electorate about where that money is going. And you could see that in a Wall Street Journal report today that looked at this letter from some Republican members of Congress asking the administration to explain what is the end game when it comes to Ukraine. So for Zelensky, that is truly the most important meeting he has.
And in the U.S., there's a question about wrangling all the troops, so to speak, in Washington, D.C. But how much is the U.S. still on the same page with its allies as well? I mean, there seems to be a splintering more broadly around the tolerance at a time where fiscal spending is constrained.
Well, these questions, your point, are not just happening in Washington, D.C. They're happening in capitals across the Western Alliance. They're happening in Warsaw. They're happening in Berlin. People want to know, to what end are we going to continue supporting Ukraine if we are dealing with our own problems at home, notably higher inflation? Now, it hasn't cracked so much where no one is really saying this out in the open in terms of the heads of state. But obviously, these are questions they are dealing with. And a lot of them, like Poland, has parliamentary elections coming up. So these are concerns that they have. But at the moment, they still want to make sure that they are projecting a united front behind Kyiv.
MH, let's wrap it up. All of these guys are going to leave. New Yorkers get their Manhattan back. After they've gone and we sit here, can we say that this was a successful UN General Assembly? Did things get done here?
I think it depends on what part of the region we're talking about. Was it successful in the sense that we did have a Netanyahu-Biden meeting that's talked about potential normalization between Saudi Arabia and Israel, which Mohammed bin Salman, the Crown Prince, spoke about with Fox News last night? I would say for the U.S. administration, that is quite successful. Did Zelensky make his points? Yes. But at the same time, the only permanent member of the Security Council that showed up to the UN was Joe Biden.
AMH, thank you. Wonderful work over the last couple of days. Bloomberg's Anne Marie out of New York this week for the UN General Assembly. On the Bank of England rate decision, Kit Jukes of SocGen with us around the table here in London on the Bank of England and a certain North London derby taking place this Sunday. Equity futures, session lows from London. This is Bloomberg. Equity session lows. We're shaping up as follows. We're down by 0.8% on the S&P 500. On the Nasdaq, we're negative by more than 1 full percentage point. Losses yesterday, negative follow through. Blame the bond market. Blame Chairman Powell. In the bond market right now, the 2-year pushing 520 early this morning. New cycle highs in the last 24 hours. Currently 515.88, pulling back by a couple of basis points on a 2-year. On a 10-year, just amazing to see this. A 10-year getting into the 440s after we heard BMO say the 10-year was a screaming buy. Morgan Stanley thinks we can break below 4%. Wells Fargo, we're talking up 350 on a 10-year, and yields keep pushing higher by another 3 basis points this morning. Lisa, on a 30-year, similar move. This time, we're pushing 450 on a 30-year in America.
I did catch in the corner of my eye Bob Michael the other day, and I asked him, are you still at 3% across the curve? And he's like, yeah, this is just temporary. And you have to wonder at some point, when is it not temporary anymore? Not just for him, but for all of the people out there who've been going into duration saying, now's a great time to pick up yield. Why not?
Yields up, stocks down, dollar stronger. The euro looks like this, 106.38, negative 0.2%. Sterling at the moment, 122.55. We're negative there by almost 0.75% on the pound after the Bank of England TK leaves things unchanged.
Oh, they leave it unchanged. There's a lot going on here. The focus, particularly for the American audience, is the dissent, the split that's available there. It is like the Supreme Court decision, John. It's a 5-4 decision.
It's a 5-4 split on a 9-person MPC. Under surveillance this morning, that Bank of England split, following the Fed's footsteps, leaving rates unchanged at their meeting this morning. But as TK mentioned, a 5-4 split. 4 voters on the MPC still pushing for another hike. This ends a series of 14 successive interest rate hikes that started all the way back in December of 2021. I remember the conversation. I had the day off work. Bramo called me live on TV, got me to work because I said it was year over, thinking the Bank of England weren't going to go just yet. They started. And I said on the phone, I remember at the time, what's important here, Bramo, is how far they go.
Exactly.
And they kept going.
Exactly. Further than anyone had expected.
Yeah, big time.
And here we are. And so now, really, the key question is, can they pause, right? Is this a pause before another hike, or is this a pause before cuts? And that's really the question over at the Fed. And it's also the question at the Bank of England.
The mistake is to compartmentalize this into the United Kingdom. For our American audience waking up, you can pull Bank of England and, dare I say, John, Bank of Japan tomorrow, right over and synthesize it into the American rate market. And we see it in equities as well. VIX out through 16 and NASDAQ down a stick.
BOJ next up tomorrow. Let's get you the update on the latest with the strikes. Stellantis proposing a new contract to the United Auto Workers. The deal offering a similar price increase and failing to give workers the clear vision of the future they are seeking. This all according to a union negotiator. The union is set to hold a Facebook Live event at 10 a.m. tomorrow morning, where it's expected to announce whether more plants will join the strike. And ultimately, this is going to be down to whether we can make some progress between now, Lisa, and then.
What does progress mean? I think you asked that a couple of days ago, and the answer is we don't know. But it has more to do, like Tom said, than just about money. This is about what products they're going to make. There was one union leader who was in the picket line who said the holdup is product. They didn't want to line up products for our plants for the future. How much is this direct repudiation of electric vehicle manufacturing and the percentage of jobs for that area that are unionized?
John, I'm colored by the massive EV debate in London this morning. It is front and center in the United Kingdom, and I underplayed that, and I was wrong. I think this EV discussion with this strike action is tangible.
The criticism of Sunak, the British Prime Minister, sounds like the following: that you're not giving businesses certainty, you're pushing out deadlines from 2030 to 2035 on phasing out the internal combustion engine and moving towards EVs. I think if you wanted to compliment the Prime Minister, he's being somewhat realistic about how quickly we can make this transition and how many people in countries like the UK, the United States for that matter as well, can actually afford this transition and how they're going to finance it. Particularly, Tom, when we're looking at a bond market like the one we're looking at this morning.
Right.
It's not as if this country right now can afford massive projects, is it?
My amateur take on this is you're precisely right. It's not a change in policy. It's an extension of the timeline.
Final story. House Speaker Kevin McCarthy winning the support of a few Republican hardliners as he looks to pass a short-term spending bill and avoid a government shutdown. McCarthy's still short of the votes needed to pass the Republican-only spending measure, which would still need to go to the Democrat-controlled Senate floor for approval. Lisa, as I read this, you're shaking your head. I think you can hear it in my voice. I can't believe we're doing this again. But ultimately, we're going to keep doing this, aren't we?
We are going to keep doing this. And as I was reading the details, I don't see how we avoid a shutdown. I really have no clue how we do that, because right now Kevin McCarthy has to wrangle all of the members in the Republican Party in the House, other than 4. He can afford to lose 4. And 2 of them are basically diehard, shut down the government until we pass 12 separate spending bills, which is just an improbability. So it's a very difficult thing to see how we avoid this, and what the consequences are, I don't know.
We have the advantages of Anne-Marie Horton, chief shutdown correspondent in Washington. And
I just drank out of your cup on accident. What is that?
What was it? Tang. It's Tang Light. We had to import it. They don't sell Tang in the United Kingdom, so we had to bring it in.
I was expecting to get like warm water.
No, it's Tang Light. Yeah,
right.
you know, it's
you
good.
Don't usually have the same color cup as me.
It gives you energy. Right now, the interview of the day. This is a scheduled 6-7 minute interview. It ought to be 2 hours. Kit Chooks joins us, chief foreign exchange strategist at Societe Generale, and he led his research note today with what I was looking at early this morning, and that is the change up there. And the change is a U.S. real yield back to where it was in late winter of 2008. Kit, things are moving. Where are we going to be a month from now? Where are we going to be 3 months from now?
Left to itself, and I think in 3 months' time we're going to have potentially still higher real yields in the U.S. keeping on this going. It's going to stop at some point. I mean, part of the discussion is the political one, right? The big difference between the United States and Europe is that we're all raising rates because we have an inflation problem, but we have to tighten fiscal policy. John just said it. We can't spend this money. We spent so much money on COVID, a war in Ukraine. We have no money, and so we're in a difficult place. The United States can spend money because it's the United States, unless the politics says it can't. So as long as the politics lets the US be exceptional, you can have higher yields and a stronger dollar as far as it goes.
What we've seen in the last 48 hours, and as John mentions, Bank of Japan has a hat trick tomorrow. Do we see, with what's moving, yen go through 148, 149, weaker yen, where all of a sudden the Bank of Japan is overcome by Powell and Bailey events?
They have to do something extraordinary at the Bank of Japan to stand in the way of this tide of rising yields in the U.S. So they'll have to raise rates or intervene. Jawboning is not going to get us much further than we are today.
So no change at the Federal Reserve, no change at the Bank of England. Are we expecting any changes from the BOJ? Not tomorrow, but this year.
He hinted at them. I heard someone else on the Bank of Japan board sort of row that back a little bit and saying he was talking to the foreign exchange market. They can't just talk to the foreign exchange market. They have to decide what they want to do with monetary policy, and it's a tough decision given their challenge. But this is so like a baby 1984, 85. I mean, it's sort of, somewhere in there. If you can imagine,
for those who were babies in the mid-80s, Kit, can you explain what a baby 1984, 85 is?
I don't want to say that Jay Powell is Paul Volcker, and I don't want to say that Joe Biden is Ronald Reagan, but it's this ability to push the dollar higher than you could imagine. I was in my first job. Everything I thought about fair value for currencies, anything I'd learned in school, was blown out of the water before we got to Plaza. This can, trying to guess how far you can go at the sort of the pointy end of this piece of the cycle is really crazy.
So we don't know how far you can go, but we do know that some people are expecting, including JP Morgan's chief equity strategist over in Japan, they expect that the Bank of Japan will leave yield curve control next year, end negative rates, possibly by even later this year, if not early next year. Do we have an understanding of what the knock-on effects would be, not just from a currency perspective, but from a rate regime globally?
I think generally, they're so far behind everybody else that it's possible that it doesn't completely rock all the boats in the world. Right? This is a country where what that would do would start the process of Japanese investors buying JGBs again at higher yields instead of buying foreign assets. So it has a knock-on effect in the currency market, but they're not as big or as important as a player on a flow basis as they were 30 years ago. So it doesn't necessarily have to start a new, long, dramatic rise in global bond yields. But it causes waves because it tightens global monetary policy one step beyond what we've been seeing. And if you forced the Chinese to follow at some point, if they don't want the yuan to weaken, you can take this further. So it all rolls it down.
We're talking about a stronger dollar and how far that can go at a time where, as you were saying, the U.S. can be exceptional as long as lawmakers allow it to be so. How far can it go before it becomes substantially problematic for the rest of the world, in particular the UK, in particular Europe?
I think it's already problematic. I mean, you already see the Chinese, who usually have complete control over things like their currency, don't like the yuan weakness. The Japanese don't like it there. If you send U.S. yields higher and the dollar stronger, you could reverse some of the wonderful progress that's been made in Latin America in the last few years. So we're not far away from people howling about what this is doing. I mean, this is the problem. A stronger dollar will be much less damaging to the United States in the short term than it is to other people.
To me, what's really important here is the analysis of a difference between Section 14 at Emirates versus Section 60. I mean, you really need the elevation to see the Spurs on, was it Saturday or Sunday, John? Do you need
Sunday,
the elevation of a Section 60, or should you go lower at Section 14?
It's a bit noisier downstairs, but I like to be able to see both ends of the pitch at the same time. I like to look diagonally across the pitch so that I can see everything
This is when
happen.
the Spurs beat Arsenal.
Then I'm very glad I've hidden away up in the nice seats.
Kit and I have watched the North
trying.
London derby together many years ago. I think maybe 9 years ago, something like that, maybe 10 years ago. It was a good time. I think Arsenal absolutely crushed Tottenham back then. I think Theo Walcott was there.
He was
back
still
then.
there.
Yeah.
Harry Kane was there as well.
How come Arsenal has U.S. ownership that's successful and other selected teams do not?
Kit, do you want to explain that? When you say selected teams, are you saying Chelsea?
I'm going to go with it took a while for them to get good at it, but that they have a heritage and a history in owning football clubs in that family.
Yeah, and
in
the
sports
Los Angeles Rams or
Stan
whatever
Kroenke.
the Rams are.
We're talking about here,
Yeah. What about the Saudi money? I mean, the petrodollar money coming in. Is that going to change Arsenal and the rest of the sport?
It changes all sports everywhere to have Saudi money coming in until the thing levels itself out. And so the problem with sport, I mean, in that sense, there's an enormous amount of money that changes it for the average fan, recognizes the fact that the economics of sport has changed, which we could talk about for a whole day, and does a bunch of things to, in the short term, to the politicization of sport, which again, is an interesting sort of thing. But at Arsenal, frankly, the change of manager was possibly the big change we made.
Yeah, Mikel Arteta. If you are just tuning in, welcome to the programme. Equity futures right now, negative by 0.8%. Yields are a little bit higher by 3 basis points to about 443.94. And if you want to talk about football, there's a big game coming up on Sunday, big North London derby, Tom.
It's a North London derby. I've never witnessed one as well. And, I mean, if I was just to the left of the director's section at Arsenal, that would, be
trying to get tickets still. Is this us lobbying for tickets, Framo? Is this it?
That's the reason why we brought Kit on, basically, entirely to see if you had tickets that you wanted to sell or just give.
You don't sell these tickets. They're willed to you.
They're willed to you.
They're willed to you.
They're really like in the...
So we caught up with Daniel Levy yesterday, the Tottenham chairman. He's been there for more than 20 years, longest serving chairman in the Premier League. Only one big trophy to speak of, if you want to call it big, was back in 2008. Tons of pressure. There's a different mood around this club now, TK, a different mood with the appointment of Big Ange. I don't know if you've heard the song, but you should listen to the song on YouTube. It's a great song. This was a man under a terrific amount of pressure. And I think what's amazing is they let go of their star player this summer, and people reflect on the summer transfer window as a success, even though Harry Kane has gone to Bayern Munich.
For our American audience, I have fun with this. I'm the dummy on the desk. And I'll tell you, John, what's so exciting to me is to see the Tots blow it up and a lot of new players. You don't see that in American sports.
We talk a bit about management decisions previously and what went wrong, what he's more comfortable with now. You mentioned Saudi money, the pressure with the Saudis coming into the business as well, and how sustainable this business is at Tottenham.
The Tots have seats at Emirates too, so maybe if I call it Mr. Levy and his team, you
think they might be at the game on Sunday?
We can work it both ways, John.
I'll bring you some of our conversation with Daniel Levy, the chairman of Tottenham, up next. Live from London, welcome to the programme. As we mentioned, the Tottenham chairman, Daniel Levy, revealing he'd be open to selling a stake in the club, quote, for the right person. I sat down with Levy for a wide-ranging interview on the club, including the recent sale of star Harry Kane to Bayern Munich. Take a listen.
So Harry was willing to stay, but he wasn't willing this summer to sign a new contract. He didn't say that to me that he wanted to leave. He didn't say that he would never sign a new contract, but he wouldn't commit this summer. And of course, we were in a very difficult position. Had 1 year on his contract, and as a club, as I said, we're self-sufficient. We couldn't live in a dream that he would sign a contract. We had no guarantee, and therefore, when Bayern Munich came along, he was willing to go to Bayern Munich, and we agreed a deal.
You've since disclosed there is a buyback clause. That's getting a lot of attention and a lot of fans excited. Can we talk about the terms of that buyback clause? What is it?
If I'm honest, I think the actual precise detail of the contract with Bayern Munich should remain confidential. All I would say is if Harry one day wants to come back to the Premier League and he wants to come to Tottenham, we would have the ability to purchase him.
We've talked a lot about Saudi Arabia and the disruption in this summer transfer window, not just for English football, but for the whole of European football. Are you getting players knocking the door now saying, I've seen Neymar's contract in the newspaper and I want a slice of that? Has this changed things for you?
I think you have to look at the Saudi Arabia situation as, it gave a huge influx of money into the market. The market is particularly tough outside of the UK at the moment. And I don't see that what's happening in Saudi Arabia is going to have any direct bearing in terms of player contracts in Europe.
What do you expect it will change?
Well, it's another market for players to look to. Not every player will want to go to Saudi Arabia, but just as not every player wants to go to Germany or France or wherever.
Joe Lewis has got his own legal problems. He's transferred his holding of the football club to Family Trust. We understand that dynamic and how things have changed in the last couple of years on that front. Technically, that means you no longer have that big billionaire backer. Do you need one to succeed? Is that something that Tottenham needs?
Well, firstly, the ownership of Tottenham has been of no relevance to the operations of Tottenham for the last 20 plus years. It's always been self-sufficient. As far as very wealthy people owning football clubs, as I said, the new rules now are going to be engineered to such an extent that hopefully you don't need to be a very wealthy owner in order to have a successful club.
Would you be open to selling a stake?
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Has anyone made an offer?
Over the years, many people have made offers, but there's never been an offer that's been...
Well, give us an idea of what those offers have looked like. Where have they come from?
All parts of the world. The Far East, the Middle East, America. But nothing has been put on our table that we felt has been in the interest of shareholders.
The stadium's been a big project for you, and clearly that's right for the club, and other people are starting to copy you as well. How big of an initiative has that been for Tottenham Football Club, and how do you think it's going to really underpin the success in not just years to come, but potentially decades?
I think people don't realise how big a project building a stadium is. That project took us probably about 17, 18 years from start to finish. I think you've got to take a very, very long-term view. I think that it obviously has a major impact on the club, positive and negative, because you don't build a stadium for nothing.
A multi-purpose stadium as well. It's not just about football anymore, is it? It's music, concerts. It's about everything else and all above.
Well, that was done for two reasons. One is, when you look at the cost of building a stadium, you're talking about such huge sums of money. In our case, it was £1.25 billion. I think today it would be over £2 billion.
Wow.
And you have to find ways of paying for that asset. And just having football games is not enough of income to
So what does music bring in, Daniel? Give me an idea of what a Taylor Swift, Beyonce music concert brings in for Tottenham. How much money can you make from something like that?
Well, every concert's different. So it's not just concerts, it's boxing, rugby, all sorts of events. You're not going to justify spending the money by all those other events. What they do, though, they make a contribution to the capital cost. I would say that over a full year, we may make £20-30 million of additional revenue as a result of it.
And what's the gate receipts look like just in terms of football over a season? How does that compare? How does that stack up?
Well, our gate receipts now are over £100 million.
Big Ange has come after Antonio Conte and Jose Mourinho. Can we talk about dealing with difficult characters? What was it like dealing with Antonio Conte near the end?
Do you know, I had a good relationship with both Jose and Antonio. They're different, and you know, as I said to my fan forum last night, I said to them, you know, I made a mistake. Right? Mistake. They are great managers. They were just not right for this club, and you know, the way they want to win is different, really, for how we need to win.
What does that mean? They're proven winners. They've won before. What does that mean?
I think there's a couple of things. I think our style of football that our fans crave for is we want attacking football, and if that means winning 4-3, then so be it. Whereas I think their style of football is, you know, they don't mind being defensive and winning 1-0. And we were in a situation where we were so desperate to win. I think at that moment in time, when I go back, you know, 4 or 5 years ago, I think we would have taken any way of winning. But we didn't win. And therefore, when you don't win, you get a very disgruntled fan base with our fans.
Where did the pressure come from to begin with to hire names like that? I was listening to the recent fan forum you did, and you mentioned that certain players wanted a certain kind of manager. You alluded to that. I'm paraphrasing to some extent. Were there certain players that wanted that kind of name? Jose Mourinho and Antonio Conte? Do they come and knock the door and ask for that?
And it wasn't about the name. It was about they wanted to win, just as much as I did. And then we'd come so close with Maurizio, who was a great manager, and he did fantastic things for this football club. And we got frustrated, and I think we went through a phase where we said, well, let's try something different, and it didn't work.
Define success for this season. Let's finish there. What is success for you this year?
That's a difficult one for me to answer, because I think I'd be putting unfair pressure on my new coach. Honestly, I think for us, though, we want to play football where we're entertained. We want to come to a game where we're looking forward to coming to a game, where we believe we have a really good chance of winning. We just want to entertain our fans.
Entertain and win?
Of course, win, but win with style.
Daniel Levy, the Tottenham chairman, will put out the full conversation over the next week or so, but a pretty extensive conversation with the longest-serving chairman of a Premier League football club, Tom.
Absolutely brilliant. There's so many ways to go here, and we don't have the time to do it, John. But I'm going to compare and contrast them with the Toronto Maple Leafs, where they really don't have to win. And you nailed that at the end of that interview, where he said he wants to entertain people. That's why Harry Kane left. It's not entertainment.
He has not been a popular chairman over the years. More popular now based on this appointment of this new manager. There's a moment in that conversation where I asked him, what is it like to hear Levy out in the stadium when a certain section of the fans are cheering that? And Tom, that is a fan first and foremost before being the chairman of the football club. And he said it's not nice when your family hears it. And you're sitting there and a certain section of the fans are singing that
They had
chant.
to go to the Bank of England off of COVID to get a loan to get through COVID. They finance this thing through Bank of America, Merrill Lynch, $1.2 billion all in pounds to build that palace. I've had the honor of being there. Thank you, Spurs. Great. Other sports teams are always looking for a bailout. Can you help us, London? Can you build the stadium with this? You know, Margaret Thatcher. Can you? No, they did it by themselves. It's a triumph.
So it's a multi-purpose stadium as well, which other clubs are trying to replicate, including Real Madrid. And Lisa, when he's going through the gate revenue there, you're looking at 100 million sterling per season now, gate receipts for football, 30 million for concerts, because you have the ability to have that retractable football pitch and then have the music concerts there within the season.
What I paid for the little meat pie?
That's contributing to the overall revenue.
It was outrageous.
But that's a good point about just the idea. He said it's supplemental when it comes to their income, but it's a pretty big supplement. And it raises this question of sports as entertainment almost first and foremost above winning. And I point to a couple of days ago, the Saudi Soccer League, which paid so much for all of their stars, is drawing fewer fans than Ryan Reynolds' Wrexham.
I saw that.
Which to me just highlights where we are.
Look for this entire interview, John. I love that. Can you just explain to Levy in your thank you note, it's not entertainment. Would you damn it?
From a Tottenham fan. Open to a stake sale. Some news in that conversation too. Coming up next, Jim Bullard of the St. Louis Fed, formerly of, sitting down with Mike McKee.
We intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
We're running strong growth. We're running inflation that's above target, so it makes sense to guide towards higher for longer.
There is a concern on the other side of this that they're going to need a higher neutral rate.
The economy has changed since the shutdown restart, and the Federal Reserve is still struggling to come to grips with that.
The Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene from London. An extraordinary set of days, a 48 hours of history and monetary theory. The Bank of England, in violent dissent, says we will not raise rates. Less violent, Jerome Powell, everybody in agreement. We are going to stand still, unlike what Jim Bullard would do. Jim Bullard would have raised rates, John.
I tell you what, Tom, I cannot wait for this conversation with Jim Bullard. Unleashed now, he's left the Federal Reserve. Not like he needed unleashing anyway, sitting down with Mike McKee in a couple of minutes' time. I want his view on one thing, the forecast. Because you remember that almost protest dot at the bottom of the S&P dot plot many years ago? I'd love to hear what he's got to say on the median projection from this Federal Reserve. Because if you can ascribe a narrative to that median projection, to use some of Chairman Powell's language, it screams soft landing. But the chairman himself says, Lisa, that's not a baseline, that's the objective. So I'm trying to work out, what's the forecast?
And if they can't forecast anything with any accuracy, then what are they doing? Are they having some sort of thesis about what is a worse kind of prognostication, inflation or some sort of recession? They are saying the words that they care more about inflation, but their actions are leaving some people with a lot of questions.
On radio and television, Global Wall Street, stay with us right now. McKee with Bullard here in a moment. And John, what I would say is the gentleman from Indiana University, he is at Purdue in West Lafayette. That's un-American right there. I don't know how that works. The red of Indiana University over boiling it up in Purdue. I don't know.
So boiler up is Purdue.
Boiler up is Purdue, and Indiana University is
He's
you
not
win at
Purdue.
Basketball.
He's not Purdue.
He went to school at Indiana.
And he's now at Purdue.
And he's migrated to Purdue,
so boiler
where he's
up.
boiling up. That's, I think, how
Should have figured this
works.
out in a commercial break,
John,
shouldn't we? Okay.
The heart of the matter is this is the one guy who said we should not fear high interest rates. Bullard says we're not going to roll up and die in a high interest rate regime. And right now we're at the cusp of that.
And his old colleague, Governor Waller, now on the Board of Governors at the Federal Reserve, was the one who was really offering up the idea a year or so ago that perhaps we can get inflation down without too much pain in the labour market. Based on the projections we've seen yesterday, that's almost the consensus view at the moment.
Now, I'm going to continue that. Tom Melzer inventing the modern St. Louis Fed. And Lisa, this is research-based. Do your work, roll up your sleeves, look at the real economy out at the St. Louis Fed, and that's the heritage of Jim Bullard.
It's hard enough to understand what it means to raise rates to a certain level for the broader economy. What I'm curious to hear from him is when you keep them there for that long, what you understand to be the implications when the implications and the effects have been so delayed with rates that have been so low effectively for so many borrowers.
John, speed data check. I'm going to look at the real yield, the 10-year real yield out 2.08%.
Nominal yields 4.45 on a 10-year, yields up by 4 basis points. It's absolutely amazing to see the Treasury curve right now. The 30-year just short of 4.50. The 2-year, Tom, 5.17. Yields just about unchanged, but basically at cycle highs in the last 24 hours. Amazing to see.
And now, in conversation with James Bullard, the former St. Louis Fed president, our Michael McKee.
Well, thank you all very much, and we'd like to thank Jim Bullard for coming in and joining us today. I would have called you Mr. President, but now, what do we call you? Dean Bullard, I guess.
You can call me Jim.
Well, Jim is the Dean of the Daniels School of Business now at Purdue University, and we thank you for joining us today. I want to start with the dot plot. I think we have a picture of the dot plot that we can put up. For those of you on radio, you can look up the dot plot on the Fed's website, but basically, in June, the last time we put out a forecast, there was one lonely dot way at the top saying 6.25%. You left. That dot's gone. How would you have voted if you were there yesterday?
I thought this was a pretty good decision on the part of the Fed here. The higher for longer message, I think, is consistent with the rhetoric we've been hearing from the committee. Earlier this year, there was widespread prediction that there would be a recession in the second half of 2023. That recession isn't materializing. So to the extent you thought that a recession would produce extra downward pressure on inflation, that had to be taken back out. So you ended up with a higher for longer message here. I think that makes a lot of sense.
So we don't need higher rates at this point?
Well, the committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down at an appropriate pace so that the committee can get back to 2% inflation in a reasonable time frame. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy. So you have to take account of that probability when you're making policy. I think the committee has done that here.
Well, one of the interesting questions is about the forecast. John was just talking about it. You've got the Fed saying their growth forecast has doubled, their unemployment forecast has been cut significantly, and yet they're also predicting that PCE core inflation is going to go down. How does that work?
Well, I think you will get disinflation with, that's the base case. The question is, how fast will that disinflation occur? If it's a very slow disinflation, you're going to want to keep policy rate higher in order to put more pressure on so you get back to 2% sooner. And there's a little bit of probability that inflation would just stall out completely at the current levels, which would be unacceptable. Core inflation has a handle, depending on how you measure it, in the 4 range is still double or more than double the Fed's target. So you've got a long ways to go here, and I think you want insurance on the side of making sure that you get back to 2% inflation. On the real side of the economy, things look pretty good. You've got some reacceleration in the third quarter here. It looks like we've talked about it before, and unemployment still with a 3 handle looking very good.
Jay Powell wouldn't say the words, but it looks like the forecast is saying soft landing.
Yeah, I think the prospects for a soft landing are very good, but you haven't landed until you get inflation back to 2%. So you're only partway through this process, but prospects are looking good.
If that's the case, then the question becomes higher for longer. How much longer? The Fed took away 50 basis points of cuts from their forecast for next year. But how long do you think you need to lean against inflation to have an effect?
Well, there'll be data dependent on that, but I think this idea that you'd have 5% policy rate or higher over the next 18 months or so, I think that's significant and shows you resolve on the part of Chair Powell and the rest of the committee to get inflation lower. So that's quite a while. I think once you get out beyond that, the end of 24, you get into 2025, nobody knows at this point.
Well, that raises the question of lags and how long the lags might be if it takes 18 months to bring it down.
Yeah, I don't know. I haven't liked the long and variable lags story for the modern era as much. I think a lot of the transmission of monetary policy occurs pretty rapidly through financial markets in a way that was not the case in the 1960s and 50s that when Friedman was talking about long and variable lags. So I think the economy has changed. Information moves much faster. Decisions are made much faster than they would have been. And the world's more forward-looking than they would have been in the 60s and 50s. So I think you should look for impact today, or more impact today than you would have in that earlier era. And so by keeping the policy rate high right now, I think you can get disinflation to happen now. It's not really so much 2 years from now.
Well, what kind of economy will we have 2 years from now? We get the pandemic distortions in the economy out, supply and demand maybe come back into better balance, but do we have a new economy? Do we have an old economy? Where do you think neutral is? Are we going back into a rate regime that is higher than we were used to in the 2000s?
Yeah, I think, and we've talked about it before, but one of the historical examples that you want to look at here is the 1994 tightening cycle, which was not as big as this one, but set up the U.S. economy for a stellar second half of the 1990s, one of the best periods in U.S. macroeconomic history. So if you can get inflation to continue to come down here with a pretty strong economy, you could set the economy up for a productivity boom and a very strong period in the 2020s here. So hopefully that's what will happen. I think we're only partway through that process at this point. But if you really do get a soft landing, then you could look at a period of good growth, strong labor markets, high productivity growth. So I'm not saying that, that's definitely going to happen, but that's certainly one of the possibilities.
What happens, we'll have only about one question left here, but what happens with the labor market going forward? Are we going to see ongoing wage pressures because there just aren't enough people to fill the jobs out there?
Yeah, I think the labor supply is somewhat diminished from where it would have been pre-pandemic or earlier. I think you have older workers less willing to come back into the workforce, so they're kind of a marginal worker type, and they're not coming in as much. Their nest eggs are pretty robust here with high housing prices and relatively high equity prices. So I also think daycare has been kind of decimated by the pandemic, so this has changed arrangements for parents with young children, and so you just have a subdued labor supply compared to what you would have had pre-pandemic, and this is leading to continued tightness in the labor market.
Well, we thank you for coming in. We're going to send you back now to Purdue to graduate some more engineers so we can fill those empty labor slots. Jim Bullard, thank you for joining us today. We'll send it back to you in London.
Hey, Mike, can you just squeeze one extra question in? Can you ask Jim, if there's no value in the forecast, why are they still producing them after that performance from Chairman Powell yesterday? Can you ask him quickly, Mike?
Sure. John is asking, if there's no value in the forecast, then why do they keep producing them?
Well, it's what we do. I think, forecasts are useful, but only up to a point. There's a certain amount of ambient noise in the economy. You can't get away from that. You can't live with them and you can't live without them, I guess is the way you would say that.
All right. Thank you very much, John. I hope that answers your question.
Thanks, Mike. Just about. Mike, appreciate it, buddy. Fantastic work. Just one of the best, as always, and brilliant performance in the news conference from Mike McKee yesterday as well. Sitting down with the former St. Louis Fed President, Jim Bullard. TK, your view on that one?
My view on this one is this guy's courageous, and there's something about the different Fed presidents and their geographies. This is a guy steeped in the real economy, and he understands that if we have higher rates, and the real rate moments ago going to 2.09%, we will survive. There's a lot of OMG, we're all going to die. Bullard's not on that team.
There was a standout there as well, Bramo, not buying the long and variable lags argument at all.
How did you read my mind? That's what I was thinking about. I was just like, I mean, seriously, that's what I was thinking about. Other people would disagree. He's saying it has an immediate effect.
Ed Morse City coming up next from London. Good morning.
Today, surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
An average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
Triple digits by Halloween. That was the call from Amrita Sen, founder and director of research of Energy Aspects. Brent crude briefly through 95, back it away, 93.43 on the screen right now. We're down about 0.1%. WTI crude, for what it's worth, totally unchanged. Someone who's taken the other side of this, Ed Morse of Citi, he's going to be joining us next. I do want to touch on the bond market. Bonds having a difficult day at the long end, of 5 basis points on a 10-year in the US. In the UK, up by almost 11 basis points now on a UK 10-year gilt yield. The 10-year in America, 446. The 30-year, very briefly, through 450. Lisa, these are big moves in this bond market.
And they're being driven by the real yields. I keep wondering what the shift has been, and if people are getting their head around lower for or higher for longer, I should say, versus lower for longer 10 years ago. There is a question about whether this is a tacit acceptance of a higher inflation rate, of a higher benchmark neutral interest rate, and whether that's feeding out into markets more broadly.
And you bring it right over to the real economy, as Jim Bullard was doing there, and you bring it over to the idea of recession fears. I'm not looking for recession fears in the U.S., but we've had a number of guests today modeling a German reality over to a United Kingdom recession, and then you go on there around the world when you see elevated real yields.
I know you're itching to do this. Have you got the orb ready?
We got the orb ready, folks. We're right here. We demanded this when we designed the set here.
Does anyone remember what the orb was?
Yes. This is the Saudi Arabia. There it is. A nice wide shot.
Thank you, with the Saudi royals. And
there. That's perfect here. We've got the orb here.
What was that?
I have no idea.
I still don't know.
Stretch it out, Bramo. You can stretch it out.
Yeah.
We do this going
over
into
everything.
What happens?
An expert on Saudi Arabia, Edward Morris, holds court at Citigroup, global head of commodity research, and always takes a geopolitical look. He has been brilliant over the last 2 years of saying, everyone calm down. We're going to see lower oil prices, more sustained $70, $80 prices, and then things have changed. Ed Morris, what changed to elevate oil to $100 a barrel?
Well, it's quite simple. A bunch of countries that had a lot of surplus capacity decided to rein it in and pull back. If you look at the oil market, there's no more oversupplied market in the world based on supply and demand. But those that have the supply have pulled it back, and they pulled it back because they didn't like the revenue that they were getting. So there's a big difference between oil and copper and oil and a lot of other commodities in terms of the fundamental availability of supply in that market.
Right. We were making fun and jest of the orb, and that is, of course, President Trump visiting Saudi Arabia. What is the U.S. relationship now with oil-producing Saudi Arabia? Has it changed?
Yes, it certainly has changed, and it's changed dramatically. Part of the change relates to the geopolitics of the area. We saw one element of the change at the G20 meeting when a number of countries that include India, include countries in the Middle East, including Israel, include the European Union, decided to build physical, their own Belt and Road Initiative. And they excluded China and they excluded Russia from it. But the U.S. is very much a part of it. We're talking about Westinghouse technology going into Saudi nuclear power. We're talking about guarantee on the security side. We're talking about oil markets and common and differences among them. But it is a different relationship from the more sour one with which the Biden administration began itself in office.
Ed, earlier in the year, you were the lone caller for some sort of lower oil price, and you were absolutely correct. Now you're coming out and pushing against people who are really upgrading their forecasts for oil in light of some of the Saudi Arabian production cuts. How can you be so sure this time around if this is essentially Saudi Arabia searching for $90 to $100 a barrel of oil for their financial well-being?
Sure. Well, I think there are 3 or 4 factors that just overwhelm it. One of them happens to be what we call the Fragile Five countries. They are Iran, Iraq, Libya, Nigeria. Nigeria and Venezuela, they're countries that in 1998 were growing really rapidly in their production. People thought they were going to be adding 1 million barrels a day a year. 5 years after 1998, they were producing less than they were in 98. The world scrambled to find new supply and the price of oil went up. These countries are adding supply in surprising ways. If you look at June versus June, 2023 versus 2022, these countries added over 1 million barrels a day to oil supply. If you look at where they are now and just look at Iran and Iraq, the chances are that the two of them together are going to be adding close to 1 billion barrels a day of production between now and a year from now. That big change, and the change is not just among the two of them. If you look at Nigeria since the recent elections, they went from the monthly average of 1 to 1.2 million barrels a day to now 1.5 to 1.7 million barrels a day. They're at 1.7 right now. So those fragile 5 countries are not under the control of the leadership of OPEC Plus, and they intend to put more oil in the market. A second really massive factor is China. China has, yes, an economy that is more commodity dependent than any other country in the world. But what China has done since the great financial crisis, and done it consistently, is buy low and sell high. So they accumulate an incredible amount of inventory. The inventory that they've grown has been from just under 1 billion barrels at the beginning of the pandemic, not very long ago, to 1.4 billion barrels in our judgment right now, with a capacity to go to 2 billion barrels. 1.4 billion means they have 130 or 140 days of forward supply in their inventory system. The IEA, in its wisdom, says 90 days of forward supply is ample. So they're in a position to do what they're now doing, buying less oil in the market. They had 4 months in which they were buying 12.5 million barrels a day. They have 4.5 million of their own production. They had months in which they had 17 million of supply. They don't refine more than 14.8, 14.9. They put it in inventory. And now that prices are very high, what are they doing? They're selling, and they're selling incrementally an awful lot of diesel into a market which is diesel, poor, and where diesel cracks are overwhelming. So they're making money by not buying and by selling high on the product side. And then we still have ample production growth from non-OPEC. Our judgment is that demand is going to be slow because of all the macroeconomic trends you guys have been talking about for the last 15 minutes. We don't think demand is going to be growing, more than 1.2 million maybe barrels a day next year. And non-OPEC alone can fill that without even thinking about the fragile 5 or what China is doing. So I think, the way we look at the trends, it's going to be a weaker market.
Just quickly here, Ed, in the interest of time, what you basically said is that China is building its own SPR that's much bigger than the U.S. as the U.S. was trading their own SPR. How much is Saudi Arabia going to keep production low simply because they know China is not going to be a big buyer?
I don't know. I don't know how to read the tea leaves on it. There was an article in Arab News involving a conversation between the Crown Prince and the Prime Minister of India at the G20 meeting. And the Crown Prince is quoted in a Saudi newspaper, therefore it's intentional, that if oil sustains above a certain level, they'll be putting more oil back in the market, or there are good chances of it. That was not an accidental story. So we don't know what the pressure point is. They like 90. They don't like 80 or 70 as much as they like 90, and they're fearful of what happens at 100.
Ed, thank you, sir, for the update off the desk over at Citi. Ed Morse there. Not as bullish as some. Not as bullish as Amrita Sen, that's for sure. Looking for triple-digit crude by Halloween. Brahma, we are pulling back to about 89.60. You just wonder how much this higher for longer message filters through the commodity market as well.
If you have money coming into real rates, are people going to want to buy and own physical product? That has been the big question.
Callum Pickering of Berenberg is joining us next. Big 24 hours for central banks. Another big 24 hours still to come. We've had the Federal Reserve and the Bank of England. It's the BOJ's turn tomorrow.
Parliament.
Economic data incoming, jobless claims about 20 seconds away. Going into it, what a move in this market. Equities lower on the S&P 500, down by 0.8%. On the Nasdaq, down by more than 1 full percentage point. Here's the why. Your wires in the bond market, yields a whole lot higher. Your 2-year through 5%, looking at 520. Wow. Your 10-year having a look at 450, up by 6 basis points to about 447. Gilt yields TK up by 11 basis points. With your jobless claims wow data, here's Mike McKee.
Jobless claims wow data is right, John. 201,000 jobless claims filed last week. That is an extraordinarily low number given the situation that we're in here. It looks like companies are just holding on to workers. 1,662,000 continuing claims, and that is lower than the previous week, but I don't have the revisions yet. Everybody trying to load up these numbers here. Here we go. Last week revised only by 1,000 to 221,000. So a drop of 20,000 in jobless claims. And last week's 1,683,000 goes to 662. So a big drop in continuing claims as well. Also mentioned the Philadelphia Fed business outlook is a bad number, negative 13.5, down from 12 the prior month. So business conditions in that area around the Philadelphia Fed not as good as they had been. One thing I would note here is that the United Auto Workers strike began last Friday. So there wouldn't be time for auto workers who are laid off to have filed. So next week you can start to expect some really distorted numbers in the jobless claims numbers. If you're on strike, you're not eligible. But if you are laid off because your plant's shut because some people are on strike, then you are eligible. So we can expect to see some filings for next week, guys. And so this 201 may be the last clean read we have in a while. But boy, it is a pretty low number.
Mike, Tom has questions. I just want to turn to the price action briefly. Session lows, down about 1% on the S&P, down by 1.3 on the Nasdaq, and cycle highs in the bond market. Can we just turn to the 10-year just briefly? The 10-year at the moment coming really, really close to 450. The 10-year, the higher the session, 448.20. At the moment, we're at 447.38. At the front end of the curve, we've seen new cycle highs earlier on this morning pushing 520. Higher the session, 519.73. We're getting closer again, 518 on a 2-year this morning. TK, you raised what this might mean for foreign exchange. Well, I can tell you, if yields are higher like this, everything else is weaker against the dollar right now, including the euro. The euro drops to about 106.30. Tom, on that currency pair, negative about 0.3%.
Michael McKee, what's so important in this with your wonderful conversation with Dr. Bullard and also your wonderful conversation yesterday with Dr. Powell at the Fed? Mike McKee, is the Fed aware that these levels are getting back to, dare I say, 08, 07, 2006 levels?
Well, they are, and I think that's why you saw them go on hold for an indefinite period. My guess is that they don't raise rates again going forward. The Fed sees what's going on in the economy, and they've adjusted their forecasts, whether they're worth anything or not, as our discussion with Jim Bullard was about. But they're looking at an unemployment rate of 3.8% at the end of the year, which is historically very, very low. There's almost no comparison to how long we've been at that level so far in this recovery. So they know that there is a very strong economy out there, and their question has to be, is that going to produce additional inflation? They don't want to say the word soft landing because they don't want to jinx it or get the markets all in a roil, but they do anticipate a soft landing, but does that bring inflation, or do they need to keep pushing because inflation goes up?
Well, Mike, haven't they just told us, if those forecasts are worth something, haven't those forecasts just told us that actually it doesn't matter for price pressure? Can we really sit here and say that this labour market data has been de-emphasised by the Federal Reserve in the last 24 hours because they now believe, based on the median projection, you can get back to 2%? without damaging the labour market at all. So the question I would ask, Mike, are they de-emphasising the importance of the labour market to overall price pressure based on what you saw in those forecasts yesterday?
You almost have to wonder, John, about that, but I would say they are not de-emphasizing it so much as accepting reality. They can't explain why, at this point, the labor market can be so tight and we don't get ongoing wage pressures. I mean, wages are still higher than they need to be, but they have come down. So what is going on around here? That is the question for them. The Phillips curve relationships they depend on don't seem to be holding. And so they're accepting reality, but I think that's one reason they are leaving in the idea of a possible rate increase by the end of the year, just in case they're wrong about that unemployment starts to get lower and push up wages again.
Michael McKee, thank you so much, and congratulations on that important interview with Mr. Bullard earlier today. It is a jumble today. You're really seeing it in the markets moving. It really sets up nicely our credit seminar with Apollo that you're going to see here later this afternoon.
Perfect timing for that.
We need to combine the belief here of what we see from the Bank of England into the Fed action yesterday. Caleb Pickering is more than qualified to do this, senior economist at Berenberg, sharing duties with Mickey Levy as well. And John, what's even more important is you and Caleb survived Thursday nights at the University of Warwick Student Union. I mean, both of you at different times.
Let's not start causing trouble.
You survived the party scene at the University of Warwick. Why don't you bring in your fellow colleague at work?
I'm so happy I've just got a quote ready to go from Andrew Hodenhorst over at Citi. Good morning to you, Callum.
Good morning.
This from Andrew. The Fed is projecting inflation to steadily cool while the labour market remains historically tight. But in Citi's view, a sustained imbalance in the labour market is more likely to keep inflation stuck above target. You kind of got to pick a side. Is it the Fed's projections, or are you with Citi on this one?
I'm actually with the Fed's projections, I've got to say. I'm fairly sanguine about this whole wage price spiral risk. Question is, do we trust our Phillips curve models? The conditionality for a wage price spiral is typically, and this is what we saw in the 1970s, inflation expectations are very high. We then factor that into our wage setting, that becomes embedded and self-fulfilling, and then you get the spiral effect. Inflation expectations are fairly well behaved for consumers, basically around the advanced world. It suggests to me we don't like the fact that we were poorer last year and we want some compensation for that. But if my inflation expectations are well anchored and monetary policy is tight, then with a lag, wages should follow inflation down. That's what we see in the US. It's what we should soon see in Europe.
So is the arch view here that the pandemic took us away from core theory, and now that we're beyond the pandemic, Phillips curve dynamics come back into play?
I think so. I think normal business cycle dynamics come back. The curious thing about the pandemic was that actually preceding the pandemic, fundamentals more or less looked fine, but we were in this chronic funk of sluggishness and pessimism. We locked the economy up, we juiced it, and we unleashed an almighty amount of economic energy, and things now start to look normal. And so in markets, we're saying all the time, what do these higher bond yields mean? Actually, from an economist perspective, we should say, why are bond yields rising? What if the world is just returning to normal? If that's the case, then these bond yields make sense.
But then why should unemployment rates rise, and why should you have that increasing slack in the labor market that would lead to wages not driving things higher, given the fact that if you just look at bond yields, you look at what we just got from jobless claims, what you see is what you get. We're seeing a lot of strength.
Well, I think the strength is actually the point. The strength is the reason for the higher bond yields. If we have higher bond yields because we've got less gas in the world and inflation is running high, that's a problem. That's a double whammy. But if higher interest rates are just telling you that the economy is strong, that's not a big deal. If we have rising unemployment, modestly rising unemployment in a growing economy, it could simply be that firms find it too expensive to hire, they can easily expand production through capital investment, and so they do that.
Do you buy into this whole idea that Jim Bullard was putting out there of the St. Louis Fed, that he doesn't buy the long and variable lags, that basically monetary policy is coming through as it is? If they hold rates higher, it'll simply be because things are responding in suit and the strength has continued? Or do you think that we might get a bigger whammy than we expect as companies and consumers have to refinance?
I'm with the former. I think we roughly know what the impact of monetary policy is so far, and if interest rates remain higher for longer, in the Bank of England they called it the table mountain, it's because the economy deserves higher interest rates. In short, if we don't have less supply in the world, if it's because demand is strong, then that's basically a good outcome, I think.
In many ways, the Federal Reserve was market to market. Yep. We already know the growth figures were better than expected since June, and they've extrapolated out current dynamics into next year and the year after. We can have a long debate about whether they should or not. I want to talk about the reality of UK growth right now. Yep. It was pointed out to me almost immediately to look at this line that they've seen the PMIs at the Bank of England ahead of the PMIs tomorrow. How bad are those PMIs going to be?
The PMIs could be quite bad heading through the second half of the year, although I would be wary placing too much weight on them, given the fact that they provided recession signals over recent years, ones which we haven't got. The key issue for the UK, no doubt, is monetary policy. There's a risk of a technical recession over winter, although I don't see the ingredients for a severe recession or anything like a significant crisis. Economic cycles end and turn bad because you build up excesses that central banks then pop simultaneously. And so in context of this whole argument, how long will monetary policy take before it has an effect? It's not as if central bank does something and 2 years later something happens. It's the accumulating effect. And we can see across a spectrum of indicators that monetary policy is weighing on economic activity, and that economic activity is resilient, which means if we do get this technical recession, well, we just cut interest rates.
Callum, just to jump in, we always hear that line, there are no excesses. There were excesses. Strong balance sheets for consumers and corporates, got all of that. But there was a big transfer, and you know where I'm going with this, and it came from the fiscal side. Are we really sitting here and saying there were no excesses on sovereign balance sheets in the last 3 years? Because there certainly were.
So there are two excesses, and the major ones actually sit in the US. One is commercial real estate, and the other one is fiscal. Now, commercial real estate is a problem potentially for some of the banks, but I see no evidence from policymakers that they'll let any institution fail and therefore cause a systematic crisis. And so that's a concentrated problem we can discount. When it comes to fiscal, I think the only thing that the US needs to be concerned about is whether or not the bond market thinks that this is an inflationary policy at some point, in which case then the vigilantes say, you need to raise taxes, you need to cut spending. Short of that, the US can get away with a lot of borrowing. Deep, liquid markets, a robust economy, fiscal policy that's providing supply-side growth. Why, as an investor, would you not buy into this?
Can the UK?
No.
That's a problem, isn't it?
But the UK doesn't need it. The UK's got fading political uncertainty and significant pent-up demand. And so as long as the Bank of England doesn't cause a monetary policy accident, I think things look better into next year. I'm not a blue-eyed optimist for next year. I think it's going to be very difficult. I think 25 is when we see trend growth, but I think we get through winter and things should be okay.
TK's biting his tongue right now.
I'm not buying it. I just, you know what I'm thinking? OBE, overtaken, overcome by events every time. 10-year real yield just hit 2.10%. We're going to have a Mickey Levy world if we don't watch it.
Callum, good to see you.
Thank you.
Callum Pickering of Berenberg. If you are just tuning in, welcome to the programme. Equities near session lows. We're down by about 0.9%. Some big moves in the bond market, up by 8 basis points on a 10-year. 448.20 on a 10-year this morning, Tom. Just amazing to see, pushing 450 on a 2-year at the moment. The 2-year is just phenomenal, just to see this getting closer and closer to 520.
For the non-sophisticates, we are really seeing dynamics and changes. And the way you look at this is from the negative and low rates that we saw ages ago. We have migrated sharply up and breakthrough back to November, December of 2008 levels, John. When you begin to start to see us back to 05, 06 levels in some of these rates, that's a changed economy for everybody watching and listening.
Lisa, we've been having this conversation now for the best part of 18 months, and one of the number one questions we asked was, can we live with it? We're living with it, aren't we?
Well, are we?
Doing that right now.
I mean, this is my question. We are, right? We're living with it. But are we? Because if you look at the rates that people are actually paying, who's paying these rates that people are quoting, right? This is, to me, the real existential question. If you've got to pay 7% on a house, you're going to buy it?
The great refinancing is still to come on the horizon out there. That maturity wall in high yield. I know all of Bramo's worries.
I know.
It's like market therapy
all
every morning. You know, all of these worries. Not quite all of them, but you can have some of them back. Trey Trudeau on the UAW strike up next.
It's what we do. I think, you know, forecasts are useful, but only up to a point. There's a certain amount of ambient noise in the economy. You can't get away from that. But so you can't live with them and you can't live without them. I guess is the way you would say that.
The brilliant Jim Bullard, the former St. Louis Fed president, speaking with Mike McKee. Fantastic conversation exchange a little bit earlier on this hour. Sometimes Twitter gets it done, now known as X. There's some really bright people out there, particularly for the finance Twitter community. This line from Stu Hampton on Twitter this morning. I think this is really thoughtful stuff. Could these hawkish pauses be interpreted as tacit admission that stagflation is a very real possibility? I'll share that again, Lisa. Could these hawkish pauses be interpreted as tacit admission that stagflation is a very real possibility?
The idea that if they're not raising rates further, they're going to tolerate higher inflation and slowing growth, and that is the preferable recipe for them, which is otherwise known as stagflation. Maybe we kind of heard that a little bit in the UK in particular, and that's kind of why you're seeing bond yields in the long end in the UK creep higher.
Can you really get inflation back to 2% with 4% unemployment in the United States? Maybe you can. It's not for me to say that you can't, but we're asking that question today, aren't we?
If you believe that long and variable lags is an outdated theory and that what you see is what you get, then what they're basically doing is they're allowing things to be where they are as things work into the system, and that they basically are talking about stagflation.
It was interesting seeing the gilt market sell off the back of that Bank of England decision to pause, with the yield higher now on the 10-year, Tom, by almost 13 basis points in the UK, on the 30-year up by about 11 basis points. And just to give you the update on the Treasury market at the moment, 10-year just short of 450, 2-year at the moment is just short of 520.
You know, we're supposed to be measured, we're supposed to not go OMG and all that, but the answer is this is an OMG day. You see it, we're down in the equity markets, 0.9% move SPX. Dow really hasn't moved like maybe it should, but the answer is, John, bonds are speaking with a vengeance, and they're really buttressed up against breakouts, and, you know, whichever way you're looking in the series.
Lisa, not to lose sight of the equity market, of course, we are softer here. The S&P 500 negative by about 0.9% on the session.
And there's some really interesting stories under the hood. FedEx in particular reported earnings. Remember, we were saying that they were going to report earnings. They did. And you can see those shares popping up to this morning after in pre-market trading after those earnings came out. Why? Cuts to costs. And because they were getting business and able to raise prices because people were switching away from UPS because of the strikes, and they were getting some of that business back. So I thought that was kind of interesting, up about 5%. Again, what are the ripple effects of some of the strikes? We're going to be talking about that a little bit later. I want to whip through Cisco as well as Broadcom. Some interesting information with Cisco buying Splunk. It's basically artificial intelligence, cybersecurity. It's their biggest acquisition to date. So this is something.
Stock doesn't like it.
No, the stock doesn't like it because it's their biggest, acquisition to date. They're using their cash. Chuck Robbins does. He's like, this is so good. We're going to do great.
Catch up with Chuck soon. It's been a long time.
It's been a long time. Broadcom is interesting. Alphabet is thinking about dropping Broadcom as their chip supplier for AI. So the chip wars continue, and you can see that ripple effect with Broadcom shares down 1.6%. Amazon, to me, is really interesting. Those shares lower by 2.7%. And right now, in general, NASDAQ shares in general are lower just because they were the most inflated by rates where they were. But they're scrapping a planned fee on merchants that don't use its shipping services. They were under so much scrutiny for antitrust. They're not going to charge their merchants 2%. Which stock investors don't like because you're not getting the revenues. But, at the same time, how much is this going to be a steady push toward Amazon to stop monetizing some of their dominance?
To the strike in America, and I must tell you, it is sobering here in London to see a true strike of doctors really click in today at the NHS. It is different in America. It's about automobiles. And what I find is there's a lot of mythology involved. We're going to now throw the mythology out the window with Craig Trudell, who lived the mythology. He knows what a 1948 Fleetwood 60 is. It's what you bought when you'd made it after World War II. And that's just complete. What I've learned in the last 48 hours is this has nothing to do with my grandfather's UAW. What UAW are we observing into the weekend?
We're observing a UAW that is really trying to get its mojo back, right? This is a union that has given up a lot of concessions over the last couple of decades to try and get these companies at first back on their feet and then thriving. That is what we've seen. We were talking during the break about the sort of carpocalypse days of 2008 and 2009. The union gave up an awful lot to help. These companies to have a future out of that crisis, putting their retirement benefits and healthcare benefits, either doing away with them or putting them on the unions, making them union liabilities. we now have a union that is trying to claw some of that back, and companies kind of using this massive transformational change coming to this industry as a sort of wedge to resist that after 4 years of very strong profits from them.
What is the singular power in negotiations that the UAW has right now?
I think they have. We were talking just a few minutes ago about how tight the labor market is in the U.S. I do think the fact that we are regularly still hearing about challenges on the part of these companies with finding a skilled workforce. I think it's going to be something that we'll hear more and more about as we're hearing about thousands of workers being hired at battery plants across the country to meet the Biden administration's objectives to go electric, to make this transition from combustion engines to batteries. You're going to need a lot of people for that, and you're going to need people who know how to make stuff. And that is what the union has in its favor is a lack of many people left anymore who have that experience.
There are hundreds of cars that are not being produced right now, cars and trucks, because of the strikes. How much is this going to jack up car prices?
I think actually it will depend, of course, on what we hear even just tomorrow from the union in terms of what their next move is. At this point, we're hearing about 3 plants that have gone down about a week now. That isn't really going to be enough to meaningfully change things. You have also working in the company's favor the fact that over the last 6 to 8 months or so, with the chip crisis easing to a significant degree, they had a lot of inventory going into this strike versus what they would have had just a year ago.
A lot of factories outside of the U.S., in particular in Asia, have a significant proportion of robots doing a lot of the work. Is the U.S. moving in that direction? And is this basically accelerating those discussions behind closed doors among certain executives?
I think you do still see a trend toward automation, but I do think that, it's also the case that you're going to need a lot of labor even to do manufacturing of batteries and electric vehicles that, have fewer moving parts. Even Tesla, has an awful lot of people at their plants in California and Texas and in Shanghai. You do still need a lot of labor to put these vehicles together. So is there a sort of ever moving change toward more automation? Absolutely. Are these companies still going to need a lot of people? That's still the case as well.
Craig, let's finish on the UK. Prime Minister Sunak is pushing back the date for that full transition to EVs from 2030 to 2035. From your perspective and the reporting you're doing, is that electoral strategy or is that a reality check?
Very much the former. I think actually, if you look into the sort of fine print of what Boris Johnson announced just under 3 years ago, this was the plan all along. It was always going to be the case that petrol and diesel cars were going to be allowed. They just needed to have, some electrification to them from 2030 to 2035. So this is a doing away of a half-baked announcement that was sort of misinterpreted and misunderstood for the last 3 years. It's all a lot of theater. We'll see in the next, day or so whether, as the FT reported today, we'll get a zero-emission vehicle mandate particulars. I mean, we're almost into October and we still don't know as an industry how many EVs we have to sell to comply with rules here in the UK.
Amazing.
It's a mess.
I'm asking for a friend. Can I take a London taxi and bring it to America, the great electric taxi?
Tom likes the quiet.
Can you bring it over?
I learned that the reason that for the design of them, the top hat, you used to the reason was for gentlemen to be able to keep their top hat.
That's why it's like tall in the back.
I do that,
Very quick.
The maker of the London taxi is now Chinese owned. So.
I do that.
Craig, thank you, sir. Craig Trudeau of Bloomberg. We've still got a lot to talk about today. In about an hour from now, we'll be sitting down for the Bloomberg Global Credit Forum here in the City of London. We'll be catching up with Jim Zelter of Apollo Asset Management, the co-president over there. He's joining us here in the city. And what a time to have a conversation about fixed income.
Timing of this?
Just amazing with a 10-year pushing 450 TK and a 2-year getting closer to 520.
Let's plan a conference out 4 months, and can we be sure we've got a moonshot and a 10-year real yield? We can do that. Julie was amazing at that.
Yeah,
she nailed it.
Not just that, but does this change anything for them that people aren't expecting them to go down anytime soon?
Amazing. A Bloomberg surveillance special live from the Global Credit Forum here at Bloomberg. Coming up in about an hour from now from the City of London. Good morning.